welcome. You're watching Ask Profit on NDTV Profit and I'm your host Himakshi Bahuguna, and along the next half an hour I'll be taking up all your stock related queries. So don't forget to call us and WhatsApp us. The numbers are there flashing on your screens right now, viewers. And on the show I'm being joined by Prashant Tapse on the fundamentals and Sarvendra Srivastav on the technicals. Welcome to the show, gentlemen.
Very good evening.
Good evening. Now,
very good evening.
Yeah, so let's get started with the first query on the show, which is written to us by Shankar Shivai from Bengaluru, and he holds 1,000 shares of HEG. He bought it at 505 rupee a piece. Currently, he is sitting on a loss of 34,000. So first, and he's looking for a short-term view also. So directly coming to you, Sarvendra, first on this. HEG is the counter. How is it faring on the charts?
I think momentum-wise, I think possibly the short-term rally, I think, looks more mature, and what we are seeing as a monthly close, we still have maybe a session to go here. But looks like that we are having a pretty bearish kind of a monthly setup here. So I think within the short term, the stock remains weak. If I go and look at last 7-8 months, I think it's not managed to close above 570, and on monthly setups, I think it's not managed to close much above 570. And downsides, I think broadly have extended towards that 375, 400 zone. So I think still at least I think 60-70 points more downsides possible on this one.
Okay. And also let's discuss about the fundamentals of the company as well. If I look at the valuation, that's pretty stretched at this particular time. Prashant, what do you have to say on the company's fundamentals, and also if you talk about the order book, how well is it positioned?
And see, with respect to order book, it is well positioned to have a good visibility for at least 6 months to 12 months. But again, when we consider the earnings, again, with respect to the June earnings, they were pretty well. But again, valuations are pretty much stretched because of the other valuation parameters like ROC is less than 5, ROE is less than 3. So with the PE of almost 45 and with a price to book valuation of 2 plus, this looks very much expensive at this point of time. When we compare with, again, the nearest competitor with Graphite India. So I think Graphite India is trading at a 20-25 forward PE, and this stock is trading at 45. So it still looks very expensive.
Yeah. Thank you so much for that view. Now we have another WhatsApp query. So Ajit from Bengaluru is asking whether he should invest in Tata Motors or not. So, he hasn't mentioned the time horizon. Firstly, I'd like to come to you, Prashant. If somebody wants to invest in a counter like Tata Motors, keeping a long-term horizon in mind, so do you really suggest them that?
See, the near-term outlook looks very much volatile when the business has so many exposures towards China, US, UK, and also near-term you may see some kind of pressure in the stock. But again, with at least a 10% discount from the current levels, it would be a good stock to hold it for long-term. Again, I would like to advise him do it like a SIP, buy every dip and like a SIP in the stock.
Okay, so buy on dip opportunity. Sarvendra, what are the levels that one should look at?
See, I think whatever we thought as a correction on this one, I think broadly it was those targets were met when we were initially thinking of a deep correction coming into the stock. So I think going from here, I think those levels around 550 might get reached. You might go there and re-challenge those levels and try and look for strength. So I think even though if you look at that level, I think that level was also a high from the December 21 top. So my sense would be that around 540, 550, those areas, if this time around in any weakness, you go there and you kind of hold, then possibly then I'll say that medium to long-term risk rewards would be turning bullish. But as of now, I think short-term 0 to 3 months, I still see some downside headroom here towards that 550 mark.
Okay. Thank you so much for that. Now we are being joined by our first caller on the show. Udit is joining us on the phone line from Mumbai. Hi, Udit. Good evening.
Good evening, Swati. Good evening, experts. I am calling about HDFC Bank.
Yeah.
I hold HDFC Bank 90 shares. Pre-bonus price was close to 2,000 rupees.
Yeah.
Post-bonus is now trailing, is basically quoting at about 970, 975. Today it has gone down.
Yeah.
I just need to know whether I can add some more at the post-bonus stage
Yeah.
And what sort of price are we looking at? And I'm sure the fundamentals looks good.
Okay. And firstly, Mr. Udit, I'd like to correct you that I am not Swati, I am Himakshi. But yes, we do have your query.
My apology.
It's
my
absolutely
apology.
fine. It's absolutely
Yeah,
fine.
my apology getting it wrong. My apology getting wrong.
It's absolutely fine, Udit. Now, Prashant, coming to you, talking about HDFC Bank. So you've heard Udit's query there. So what advice you have for him?
So continue to hold. I think post the corporate adjustment, the stock will see some kind of pressure to get some kind of under pressure, the selling pressure in the prices. But again, fundamentally looks very strong. For me, the stock would be like a 2 to 3 years. Again, the stock may head towards 1200 and 1300 levels. So, but again, there may be some kind of near-term pressure in the stock as the sector is under pressure right now with respect to the NIM margins. Still, there is some kind of pressure for a very short period of time.
Right. And also talking about the technicals of it, Sarvendra, is HDFC Bank a counter for, for a short-term investment purpose?
See, the life of a technical analyst sometimes gets difficult. Now there are two securities merged into one after that corporate action, and whatever was there in our minds over the last 10, 12 years as patterns on the bank have mildly shifted here and there. So I think I always let such events adjust and give it 6, 12 months at least and see as to how the new chart starts forming. So my sense here would be just ballpark, I think 870, 880. That was a number that it could not take out for 2, 3 years, right from 21 onwards till 24. I think 880, 900, those levels now adjusted, I'm saying, were levels which it was not able to take out. Since it is trading above those numbers and it's I will say it's an all-time high breakout of the combined entity, I would say as long as it stays above 870, 880, short-term setups to me look positive. So it declines, if any, you might, for 0 to 3 months, you might look at buying declines towards 900 for targets of back to 980,000 and with stops below 870. That is the only ballpark setups that I can see right now. But a caveat here, Bank Nifty looks really, really weak. The way it has broken its weekly swing lows today, I am not happy with the way Bank Nifty is shaping up. And this being a heavyweight there, I think it can also get some negative brush out of that particular setup. I think Bank Nifty looks weak, and I think another 1,000, 1,500 points on the downside towards around 52,000 is what I look Bank Nifty slipping to. So I think people should be slightly alert as to what's happening on banks overall.
Yeah. Thank you so much, Sarvendra, for that. And, viewers who have, those of you who have invested in the banking space, in the banking stocks, just keep, in track that whatever's happening with Nifty Bank currently. With that, we are being joined by Mr. Murli on the phone line from Bengaluru. Hi, Mr. Murli. Good evening.
Good evening, ma'am. Thank you for taking up my query.
Yes, please query the query.
Yeah, my query is on, I bought a company called Ethos. Under shares recently, using today's fall because it went around 2,900.
Yeah.
And what is the view from a long-term point of view?
Okay, Mr. Murli. So I must say that Mr. Murli is having quite a big portfolio there because, every day we have a query of his with a new counter there. But Prashant, coming to you, talking about Ethos, what suggestion do you have for Mr. Murli?
I was waiting for Murli sir to say a lot of fundamental points, but I think yes, with respect to valuations, still they are very expensive considering the segment which is almost into the luxury watches and all. So growth is very much limited, but not at this point of time. I think H1 would not be so good, and H2 can be great for the stocks like festival seasons will start. But again, valuations are very much expensive at this point of time. You may see some kind of more pressure. The stock may go towards 2,100 or 2,000 levels. So that would be a great level for conservative investors like Murli sir to buy the stock.
Yeah, thank you so much for that. And I hope, Mr. Murli, your question has been answered there. With that, let's go across to caller joining us from Hyderabad. Hi, Vijay. Good evening.
Good evening, madam.
Yeah.
I bought 2,000 shares of Indian Bank at the rate of 626, madam.
Okay.
and I bought 25,000 of Ola shares at the rate of 53 rupees.
Okay, okay.
Shall I hold or exit?
Mr. Vijay, I'm afraid that I'll be able to cater to only one query at this point of time.
Indian
I'll
Bank.
stick to Indian Bank. Yes. So Indian Bank, you've bought it at 626. Currently, it's trading at 652. You have made some profits there of around 54,000. So Sarvendra, what's your short-term outlook on Indian Bank? Will he be able to make more profits?
I'm afraid, I think short term, I think a good swing has matured around that 670, 680 mark. So I think ideally he should have taken profits there. But I think on pullbacks, if at all we get pullbacks tomorrow or day after on Monday, I think he should be trying to book out profits if he's looking at the stock in the 0 to 3 month kind of a short term kind of a risk reward scenario. Else, as I said, this is among the stronger banks. It's outperformed the bank nifty itself. It's been steady in that space. So if the view is slightly medium to long term, then he might hold. But in the short term, I think you should kind of sell on a bounce and take some profits and look for lower levels around 580, 600 to re-enter.
Okay. Thank you so much for that view. Now we are being joined by Ravi on the phone line from Hyderabad. Hi, Ravi. Good evening. Ravi, are you there on the phone line with us? Yes, please go ahead with the query.
Yeah, I have query on Gabriel India.
Okay.
So, is it a good time to buy, or shall I wait for any further correction?
Okay, and
can the panel suggest some other attractive auto component stock?
Okay, but I'm afraid that I'll stick to Gabriel India for now. And are you a long-term investor or a short-term investor, Ravi?
Yeah, I can hold for 1 year.
1 year. Okay, 1 year outlook on Gabriel India, Prashant. Currently it's trading at 1134, was up in trade today over 1%. And if I look at the valuations as well, it seems pretty, highly valuations, pretty stretched at trading at 75.35 p. So do you really think that Gabriel India is a correct option to look at for a long-term investment purpose?
As a story, as a fundamental with respect to the business model, yes, the stock looks really good for me in terms of its model. But again, you rightly pointed out with respect to the valuations. Recently, from June, the stock has really outperformed the stock. In the month of June, it was around 600, and now it is almost trading at a 11330. So I think the stock has doubled in the recent times. So kindly avoid the stock at this point of time. I'm not telling him to avoid the stock, but I avoid the price right now. So wait and watch for a stock to get some kind of comfortable valuations near 800 or 900 rupees. Then the stock can looks good very for long term.
Okay. And Sarvendra, now I'd come to you since Prashant has pointed out that 800 to 900 levels are the correct ones to, take fresh positions at if somebody wants to invest in Gabriel India. So when are you anticipating that?
See, I think it's pretty overbought. Look at technical parameters, look at fundamentals and P's. I think the stock is absolutely overstretched. And such things, sometimes they can keep doing their own things for some time, but you'll have to keep patience. I think you'll get rewarded if you keep patience and not touch it at the moment. So I'll agree with my fundamental friend that you need to kind of wait out this move. My levels will be slightly lower, around 700, 750 odd levels. I think those are the right areas, if at all, if you want to accumulate it for the long term. Just wait it out, maybe 3-6 months, but you might get it around that 750, 800 mark.
Okay, so just wait for another 3 to 6 months and you'll get to your right levels there. With that, we have a WhatsApp query. Okay, we have a caller, my bad, joining us from Bengaluru. Hi, Yuvraj. Good evening. Yuvraj, are you there on the phone line?
Hello.
Yes, Yuvraj, please go ahead with the query.
No, ma'am. I am Naman from Indore.
Okay, so there is some cross connection happening there. So we have Naman from Indore. Am I correct?
Yes.
Okay. Yes, please go ahead, Naman.
Yeah, ma'am. First of all, good evening to all. Ma'am, I have a question on Adani Total Gas.
Okay.
I have 553 quantity at the average price of 817.
Okay.
And I am ready to wait for 1 year, ma'am. Yes, I want a feedback from sir.
Okay. So Prashant, like you can see on your screens that he is sitting on a significant loss of 1.24 lakh rupees there with Adani Total Gas. But are you optimistic on the counter? Is the fundamentals of the company strong enough that it can, weigh through the pressures?
Not in the near term. I think short term, the stock will see some kind of more pressure due to valuations only, because the way how the earnings have been shaped out, I think there will be more time for the stock to again come back to its old price. Wait for 3 to 6 months again. I think there may be some kind of good recovery in the Q2 earnings as well as in Q3 earnings. So then you can get some kind of cost back in the price. Then only we can take a decision. But time being, wait and watch. Don't add more at this point of time. Again, it's a expensive stock at this point of time again. Wait for 2 to 3 quarters, you'll get a good price back for your investments.
Okay, thank you so much for that. And just a quick disclaimer for our viewers, NDTV is a subsidiary of AMG Media Networks, which is an Adani Group company, and the channel you're watching currently. With that, we have another WhatsApp query now. Yuvraj from Bengaluru holds 750 shares of K-Fintech. He bought it at 1,056 and he's looking for a short-term outlook on it. So K-Fintech, Sarvendra, how are you viewing it from the technical perspective?
See, I think data here is limited to maybe a couple of years, so not a big long-term setup that possibly could emerge technically from here. The view itself, short to medium term, I would say we have put a short to medium term top within this pullback at around 1300, just slightly higher those numbers. I think there we have put up a short term top, and I think the lows around that 900 mark, those lows could get tested here. So I think 800, 900 is on the cards, and still some headroom on the downside.
Okay, thank you so much for that. Now we are being joined by KK Sharma on the phone line from Chandigarh. Hi KK Sharma, good evening.
Good evening, ma'am. I want to buy Can Bank or PNB for a longer term, 3 years perspective.
Okay.
Can I buy it at current price or at a lower price?
Okay, understood. Prashant, directly coming to you. In the PSU banking space, like we were discussing banks, earlier, and we are witnessing sort of a pain in the entire segment space there. But Canara Bank and Punjab National Bank, if somebody wants to invest in it, so what are the levels that they should be looking at? And also, are you optimistic, on the counters there?
Short term, again, there will be some kind of pressure in the sector as well, PSU as well as private sector banks. But again, Canara Bank looks very good for me in terms of fundamentals with respect to valuations. Very much comfortable to have a positive outlook for the stock at a price to book value of 0.9. Yes, go ahead with buying, but again, buy on dips on a long-term basis.
So buy on dips is what Prashant is suggesting. Also, Sarvendra, I'd like to take your view as well on it. Canara Bank and PNB, what is your top pick?
See, my view on the banking space, and especially Bank Nifty, slightly different here. I think we are in for a 0 to 3 months of some short to medium term kind of pain. Starting with short term, it can spill over into the medium term setups as well. And a couple of my proprietary setups or my proprietary indicators have put some sell readings on few names. So I think within the banking space, the Bank Nifty also looks weak. We are approaching the long-term markers there. I think that would be very, very important to see as to how we behave at those long-term markers. I think 53,500 thereabouts is the long-term marker for the Bank Nifty. Were we to break this, then I think more downsides would emerge for the Bank Nifty as a whole. So I would wait it out this particular space, and especially I think within the PSU names, I feel more headroom on the downside. You have to have at least a patience of 3 months. You might get better prices, as he asked. I think wait out and you will get better prices.
Okay, so wait out and you will get better prices. That's the word coming in by our experts there. Now we are being joined by Jai Kishan from Gwalior on the phone line. Hi Jai Kishan, good evening.
Madam, very good evening.
Yes.
मैडम मैंने ना अडानी विल्मर लिए हैं 2300 के रेट पे.
Okay.
हाँ, बहुत लॉस हो रहा है, और मैं एक बात और कहना चाहूँगा आपसे
जी.
मैं ना बहुत लॉस में चल रहा हूँ, और उसमें गवर्नमेंट ने मेरे से FTT, GST और स्टैंप ड्यूटी के नाम से लाखों रुपए लिए लॉस होने के बाद। मेरे को समझ में नहीं आ रहा, जब इन्वेस्टर को इतना लॉस हो रहा है तो फिर इतनी एससीटी क्यों ले रही है गवर्नमेंट, इतनी जीएसटी क्यों ले रही है उसके ऊपर, फिर स्टैंप ड्यूटी क्यों ले रही है, जिससे बहुत उससे ज्यादा नुकसान हो जाता है।
जी, मैं जयकिशन जी, मैं आपको अडानी विल्मर के जो फंडामेंटल्स हैं कि वो क्यों नीचे जा रहा है और आप क्यों इतने लॉस पे हैं, हम वो डिस्कस करेंगे और मैं अपने एक्सपर्ट से बोलूँगी कि वो आपकी ये जो क्वेरी है वो इसको सॉल्व करें। प्रशांत, कमिंग टू यू, अडानी विल्मर इज़ द काउंटर दैट ही हैज़ इन्वेस्टेड इन, ही bought it at 300 rupees. He's bought 2,000 shares, sitting on a loss of almost 1 lakh rupees. So what's your advice to him?
जय किशन जी, मैं ये बोलना चाहता हूँ कि देखो फंडामेंटली थोड़ा सा ये कंपनी में नेगेटिविटी अभी भी है। जिस तरीके से उनका एडिबल ऑयल के अंदर बिजनेसेस है, वहाँ पे मार्जिन वाइज प्रेशर बहुत है और ग्रोथ वाइज भी प्रेशर बहुत है। जिस तरीके से मैं अभी देख रहा हूँ कि शॉर्ट टर्म में अभी भी ये स्टॉक थोड़ा नेगेटिव ट्रेंड में ही जाएगा। आई थिंक जिस तरीके से Q2 अर्निंग्स भी आएंगे तभी भी इसके नंबर्स कुछ खास नहीं रहेंगे, तभी भी इसके मार्जिन वाइज प्रेशर कंटिन्यू होगा, तो स्टॉक अभी भी मुझे लगता है कि यहाँ से 10% और भी गिर सकता है। बट अगेन अगर एज ए लॉन्ग टर्म इन्वेस्टर मुझे लगता है कि थोड़ा सा यहाँ पे वेट एंड वॉच करना चाहिए, अग्रेसिवली कोई एवरेज आउट नहीं करना चाहिए। बट अगर जब कॉस्ट आता है तब इसके पास जंप में निकलना चाहिए बाहर।
सो जयकिशन जी, आई होप आपकी जो क्वेरी है वो हमारे एक्सपर्ट्स ने सॉल्व कर दी है। And just a quick disclaimer for our viewers there, NDTV is a subsidiary of AMG Media Networks, which is an Adani Group company, and the channel you're watching currently. With that, we are being joined by Ratish on the phone line from Navi Mumbai. Hi Ratish, good evening.
Hey, good evening to you, ma'am.
Yes, please query the query.
I have 2,000 shares of Bharat Electronics.
Okay.
At an average price of 337.
Yeah.
I can hold for another 1.5, 2 years. I wanted to know the fundamental views because the shares have come down quite a bit. Yeah.
Okay. So, Prashant, BL is the counter. He bought it at 337, although currently it's trading at 364. But if we look at the charts, it has been dropping significantly. But fundamentally, what's your view on it?
Again, if the investor is looking for a 1 or 2 years view, I think it's a right stock to be into. Again, it's a defense stock, majorly focused on electronic equipments and systems, which government is looking to expand and more towards export. So overall, for me, these short-term dips can be an opportunity to again add back few at the level of 340 odd levels. Again, hold it for long term. My target anywhere would be in 420 and 450 for next 1 year.
Okay. Thank you so much for that. Now, we have a WhatsApp query. So Nisha from Bengaluru holds 84 shares of HDB Financials at 740 a piece. So she hasn't mentioned the time horizon. So I'd like to take both fundamental and technical view on it quickly. Firstly, coming to you, Prashant, what's your outlook on it?
Positive again as a long-term investor. Short-term again, the NBFC as a sector may see some kind of pressure in the NIM margins again with respect to the growth possibilities. But again, I think the investor is from the IPO level of 740. I think it was the IPO price. 1 or 2 year again, the stock looks really good. NBFC can be a stock which can deliver 15-20% return for next 2 years.
Okay, so NBFC is a space that can give you 15 to 20%, returns. That's the word coming in by our experts. Now let's go across to Kumar, who is joining us on the phone line from Hyderabad. Hi, Kumar. Good evening.
Hi, madam.
Yes, please go ahead with the query.
I buy the Delta Crop shares.
Okay.
1,000 quantity at 95 rupees.
Understood.
This current price is 84 around.
Yeah.
Add some quantity for it.
Okay. So are you looking for a longer term perspective on it?
No. Short term.
Short term. Okay. So Sarvendra, Delta Corp is the counter. Although it has fallen significantly from the levels that Mr. Kumar has bought at, he bought it at 95. It's trading at 88. So is it going to go even below that, or are you seeing any sort of positivity, on the charts? Sarvendra, I'd like you to unmute yourself.
Yeah, apologies. See, I think it's a very, very volatile stock and it's a very high beta, high risk stock. I think should not be traded. I don't know his risk profile. It's a very high risk, high reward kind of a game. If you're doing this, and a lot of news keeps coming, a lot of action from development from the government side, rules and regulations which are subject to change. I think I would avoid something like this. So I would pass this question. I don't have a view here.
Okay, so Prashant, if you could just help us with that.
I think the investors already taken a risk in these risky investments. Obviously, we all know what went wrong with the stock with respect to Nazara as well as Delta. If he's a risky investor, I think he has to hold a stop loss of 82 and then take it forward.
Okay. Thank you so much for that. And we are running short of time on this edition of Ask Profit. But thank you so much once again, Prashant and Sarvendra, for always being there, being so supportive and, always solving our viewers' query. Thank you so much. And with that, viewers, it's a wrap on this edition of Ask Profit. But please don't go anywhere, as there's a lot of action lined up ahead on the other side of the break. Stay tuned.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a
Nifty falls nearly 1%, closing above the 24,500 mark after a 200-point drop from the day's high. Mid-cap and small-cap indices also fell over 1%. Banking and financial sectors continued their multi-day losing streaks, while all major sectors ended the day in the red. 50% tariffs to hit gems, jewelry, chemicals and home decor in near term. Exporters flag liquidity crunch, urging the restoration of schemes, while the government fast-tracks the export promotion mission and pushes supply chain resilience, expecting recovery in 5 to 6 months. The group of ministers on GST to recommend early ending of compensation cess to states. Proposal to end cess by October the 31st. The council will decide on this proposal when it meets on September 3rd and 4th. Amid escalating US-China trade war in March, President Xi Jinping reached out to India with a personal letter to the President Draupadi Murmu, signaling Beijing's intent to revive ties and voicing concern over the possible New Delhi-Washington trade deal, say officials. SEBI approves stockbroking and wealth management platform Grow to go public, setting the stage for an IPO that could raise up to $1 billion. The offering is expected to value the Bengaluru-based fintech at 7 to 8 billion, marking a major milestone in India's startup and financial services ecosystem. The Adani Group of companies reports a strong financial result in Q1, driven by robust operational performance and growth across key sectors, including infrastructure, energy and logistics. Federal Reserve Governor Lisa Cook sues US President Donald Trump. The Fed backs the legal move in a rare statement. This comes after Trump said she was fired, while Cook maintained he had no authority to do so. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Over the next half an hour, we're going to take you through the latest in markets as well as national and international news. But on to some breaking news coming in this evening. In a significant boost for India's fintech space, the SEBI, or the Securities and Exchange Board of India, has given the green signal for Grow's much anticipated IPO. This approval sets the stage for one of the largest fintech listings in the country, with Grow expected to raise close to $1 billion. My colleague Agni Dev now joining me on the phone line with more details. Agni, first take us through what actually Grow is. We believe it's an online discount broking and direct mutual fund investment platform. But take us through that and, more importantly, the context of this entire IPO.
Right, Sanjana. So first of all, let me tell you what Grow is. So as our viewers will be aware, Grow is currently India's largest discount broking platform. It's even ahead of Zerodha in terms of total active clients, and it's been at the forefront for the last few months. So India's biggest stock broking platform is now going to come out with an IPO of its own. Now, sources are telling us that the IPO papers which Grow had filed confidentially earlier this year have likely been approved by SEBI. What this entails is that the company is now going to file an updated DRHP, which will be a public document, which is an important point to note, because once the documents are public, the company's financials, the way it operates, everything will be publicly available information. Now, sources also tell us that the IPO is likely to be $1 billion in size, which will value the company at around $7 to $8 billion. Now, this means that there will be a dilution of around 10 to 15%, which is the norm for IPOs of this size. And an earlier announcement by Grow had also revealed that the shares are expected to be listed on both NSE and BSE main boards with a face value of ₹2 each. Now, this is a developing story. We will be reaching out to the company for their comments, so do stay tuned.
Right, Agni, thank you so much for that update. This is what we know so far. The company may raise up to $1 billion, but the SEBI has essentially green-lighted Grow's entry and its IPO. And moving on, we're hearing from government sources this evening that the new 50% tariff imposed by the United States is set to significantly dent India's trade flows. Officials admit that there could be short-term disruption as supply chains are forced to recalibrate, but stress that resilience measures are already in the works.
Right, what we're picking up from the government is the fact that the 50% tariffs that came into force on August 27, there will be an impact that is seen, but what the government is foreseeing is the fact that this impact will be coming in over the next 5 to 6 months. There will be a certain pain that these industries will have to go through, especially labor-intensive sectors such as jewelry, gems and jewelry, chemicals, home decors, which includes carpets and furniture. What we're also seeing is that this impact will be short-lived. It will be a jolt, but once the supply chains are recalibrated over the next 5 to 6 months, we'll see this pain easing out for these exporters. But given the fact that there is pain coming out, the government is cognizant of that fact, and work is on. Fast-paced consultations, in fact, are on for the export promotion mission. This is a package that was announced in the budget this year, and it was announced initially as a 20 to 50 crore rupee project for a single year, but now it's being revamped and being rolled out as a 6-year package that will be with an outlay of 25,000 crore. That is something that we've already reported on. What we're also seeing is that the government is very focused on boosting e-commerce exports. The likes of Amazon and Flipkart, they will, on a pilot basis, possibly be allowed to run an inventory place model instead of a marketplace based model, and that will also boost e-commerce exports. That is also a story that NDTV Profit broke about a couple of days back. There is an anticipated liquidity crunch for which there will be certain amount of interest subvention schemes, market access initiatives, as well as restoration of old schemes such as the ROTTEP scheme, which are in the works as part of the export promotion mission. What we're also picking up from government sources is the fact that the focus remains on big ticket reforms, and these big ticket reforms like the 100-day reforms agenda, we have the GST rate rationalization coming up as well. Both of them are expected to boost domestic demand, and in a way that will also help cushion the impact of these tariffs. So that is what we're picking up from the government. Another important point on the next date of negotiations for the bilateral trade agreement, that has not been finalized yet, but channels remain open, and that is something that the government is working on. They very well remain hopeful of some sort of a resolution to this tariff standoff.
Right, Rishabh, thanks so much for that. And some news that came in today, a private letter from Chinese President Xi Jinping to Indian President Draupadi Murmu has come to light. This letter was sent back in March during a period of rising US and China trade tensions, expressing concerns over US agreements that could negatively impact China's interest. Xi's letter, also sent to Prime Minister Narendra Modi, named a specific provincial official to lead talks with India. Now, following this communication, then India began working on improving relations with China in June. This effort has led to an acceleration in the settlement of border disputes, with China describing the improvement in relations as the dragon-elephant tango. Now, remember, National Security Advisor Ajit Doval is leading the discussions for India, and China has also guaranteed India's supply of fertilizers and rare earth. The resumption of direct flights between the two countries is scheduled for next month, and India has lifted its restrictions on tourist visas for Chinese citizens. However, all eyes now are turning to the upcoming summit between the Chinese President Xi Jinping and, of course, Prime Minister Narendra Modi in China at the end of the week. The Prime Minister Modi's first visit since 2018 is more than symbolic, because this visit represents the most serious attempt in years to recalibrate ties after the deadly 2020 border clashes, the worst rupture in India-China relations in over 4 decades. Now, this meeting is being watched as a possible inflection point. Can Asia's two biggest powers move from confrontation to cautious operation? Let's find out. First up, let's look at the numbers, because they actually tell a story. Trade has never been bigger. Nearly $128 billion in FY 24-25, making China India's second largest partner. But the imbalance is also glaring. For every dollar India exports, it imports almost 8 back. Electronics, Machinery and chemicals dominate what comes in. But here's what goes out. Raw commodities like iron ore and cotton, and the result, a $99 billion gap. Then let's take a look at why things soured before. It wasn't always this high. In 2020 and 2021, trade dropped sharply. COVID played a role, but so did the Galwan issue. Apps were banned, investments screened, imports curbed, and India's exports to China barely moved in the years after. All of that slowed down by non-tariff barriers and regulatory walls. At the same time, we saw China deliberately squeeze supplies of rare earths and fertilizers. Add US tariffs to the mix, and New Delhi was forced to rethink how much it should actually depend on Beijing. Now let's have a look at what the SCO could actually mean, this summit. That rethink is now meeting this new opportunity, which is in the form of the summit. Under China's presidency, both sides could separate border tensions from trade, and resuming direct flights, expanding market access, and even exploring joint energy and manufacturing projects are on the table. With SCO trade at nearly 900 billion, India doesn't want to be left behind. And if security talks succeed, it may also reduce border flare-ups. Let's also look at what has already happened, which China is calling the dragon-elephant tango. This dance is already visible. Border trade has quietly restarted at 3 Himalayan posts. New working groups are in place to manage disputes, and diplomatically, Xi Jinping reached out privately earlier this year, followed by a visit from China's foreign minister. So economically, export curbs are being lifted, flights and visas set to return, and culturally, we're also seeing 2025 as the year where the Kailash pilgrimages expand as both nations mark 75 years of ties. So is this a reset or just another phase in a cycle of friction and cooperation? For India, the challenge is clear: engage enough to benefit from trade, but also cautious enough to guard its borders. The world will be watching if the dragon and the elephant can truly dance without stepping on each other's feet. Meanwhile, let's take a look at how the markets fared today. Trump's tariff tirade triggered heavy selling pressure on Dalal Street, with benchmark indices closing near their intraday lows. The Nifty slipped to around 24,500, while the Sensex ended near 80,000. All sectors finished in the red, led by steep losses in IT, defense and realty. My colleague Puneet now joining us with a quick wrap-up of today's market action.
Well, it was another day when we saw the benchmark indices largely being under pressure today. We also saw some pain essentially in the broader markets, but let's first start with the Nifty. It fell from 200 points from the day's high, and quite a similar performance that we saw on Tuesday as well before the market holiday yesterday, where we've seen continuous pressure on the Nifty and no recovery in sight. For the Nifty 50, we saw stocks like Shriram Finance as well as HCL Tech fall the most, while some stocks in the auto space like Hero MotoCorp and Eicher tried to provide some solace. They also ended below the day's high as well and saw some massive correction in the Nifty auto as well, with most stocks slipping in the red at the end of the day. Apart from that, Nifty has fallen over 2% in the last 5 days, and that's largely based on what's happened with the tariff tantrum amongst other reasons. The GST did provide a boost to the market as well as some key sectors like auto as well as electronics and consumer durables, but that failed to sustain and ground over essentially over what's happening with the global geopolitical issues. Apart from that, we've seen the Nifty fall nearly 1% for the day. Benchmark indices largely were slightly higher than the broader markets, but even we saw pressure in the mid cap and the small cap as well. In the mid cap 150, it fell over 1%. That was dragged essentially by Poonawalla FinCorp as well as Aditya Birla Corp amongst other stocks. We've also seen essentially over the small cap lose over 1%, led by stocks essentially like Electra Green Tech as well as something like CESC, which also dragged the small cap index down. Finally, in terms of sectoral indices, the Nifty IT essentially fell the most during the trading session today. If any, we could see some solace if there's a rate cut in September, but till then, we could see some pressure on the Nifty IT over the medium term as well. Apart from that, it emerged as the worst sector for the day. HCL Tech as well as LTTS was the other stock that got impacted. ICICI Bank and HDFC contributed the most to decline essentially in the Nifty and the Nifty Bank as well as financial loose for the 4th consecutive session. We will be entering a new expiry from tomorrow. Foreign investors have largely maintained short positions, but we are expecting, at least for now, not any kind of meaningful triggers which could have a positive impact on these indexes.
Right, Puneet, thanks so much for that. Meanwhile, India's industrial output in the month of July grew by a solid 3.5%, coming in at a 4-month high. This indicates a steady industrial performance despite Trump's tariff pressure. Let's go across to my colleague Pallavi for a detailed breakdown of the figures.
India's industrial production came in at a 4-month high at 3.5%. That's for the month of July, and that's according to data by the Ministry of Statistics that was put out on Thursday. This growth was above estimates, and it was led predominantly by the manufacturing sector, which comprises the largest segment of the index. Now, manufacturing activity grew by about 5.4%. That's on an annual basis for the month of July, and that's compared to 3.7% we had seen in the preceding month. Mining as well as electricity production, however, saw a contraction. Coming to the use-based internals, primary goods output recorded a contraction of 1.7%, while capital goods grew by 5%. Intermediate goods grew by 5.8%, while infrastructure goods recorded a growth of 7.2%. Consumer durables also saw some growth, while consumer non-durables saw some degrowth, coming in at minus 0.4% for the month.
Thanks, Pallavi, for that. Meanwhile, Union IT Minister Ashwini Vaishnav announced that India's first made-in-India semiconductor chip is expected to be produced soon at the CG Semiconductors plant in Sanand in Gujarat. He also highlighted the steady progress at the Micron plant in Sanand. My colleague Rishabh caught up with him on the sidelines of the event. Let's take a look.
The first baby has come out of ISM 1.0 finally. We can see successful mission. Talk to us about how important this is and what industries in India stand to gain from this.
So, as a part of the semiconductor mission, the 10 plants which were approved, construction is going on at a very rapid pace in the first 5 plants. And out of that CG Power, the pilot line got started today. This pilot line will start producing manufacturing very soon, and the students who have got training in semiconductor manufacturing, you can see them, the young students, they are so full of confidence that they'll be producing the world-class chips, some of the most modern chips they'll be producing here in this plant. This is a very important step for our semiconductor mission because once we start producing the semiconductor chips, they'll be supporting so many sectors. The automobile sector, the industrial sector, the infrastructure, the consumer electronics, all these sectors will start getting the made in India chips.
And in a significant relief for Bajaj Alliance policyholders, the Association of Healthcare Providers India is likely to roll back its advisory to cease cashless services for Bajaj Alliance General Insurance. Now, CFOs from 4 major hospitals recently met with leading insurance companies to discuss reimbursement cost revisions. My colleague Pallavi now joining us with more on this developing story.
Right now, according to sources to NDTV Profit, the AHPI, that is the Association of Hospital Providers in India, is likely to roll back the advisory regarding seizing cashless services for Bajaj Alliance General Insurance policyholders. Now, according to what we have been able to gather so far, the CFOs of at least 4 major hospitals met with representatives from Bajaj Alliance to discuss reimbursement costs. Now, the issues which were discussed in the meeting on Thursday also included new hospital empanelment, the revision of rates, which the Hospital Provider Association said that Bajaj Alliance has not been doing frequently enough, causing financial distress to some of these hospitals. Also, the stoppage of cashless services, as well as the deduction at the time of payments. Now, Now, insurance companies are likely to further engage with the association regarding the renegotiation of reimbursement costs. So far, we have seen Bajaj Alliance get into these discussions, but this is likely to set the template for more such discussions and renegotiations to follow in the coming days.
Thanks, Pallavi, for that. And moving on, the newly enacted Online Gaming Act, which is less than a week old, is already facing legal challenges. Head Digital Works, the company behind the popular online gaming platform A23, has filed a petition opposing the blanket ban on online money gaming in India. The crucial hearing is scheduled for August 30th in the Karnataka High Court. Let's go across now to my colleague Charu for more details on this.
The Karnataka High Court has decided to hear the legal challenge to the Online Gaming Bill 2025. Now, the case has been filed by the company Head Digital Works that owns the platform A23. This is the first legal challenge that has been filed in the court of law, and the case has been slated for its next hearing on August 30, while the case was mentioned for the first time before the Bangalore bench of Karnataka High Court on August 28, that is today. Now, the most important submission that has been made in the petition copy reviewed by NDTV Profit is that no public consultation or consultations from the stakeholders affected by these laws were really taken into consideration before passing or enacting the law, and that is why they want their stance heard before the High Court at first, and a writ petition regarding the same has been filed.
Thanks, Charu, for that. And moving on to some news coming in from the US, Federal Reserve Governor Lisa Cook has filed a lawsuit to block Donald Trump's attempt to fire her from the central bank's board. Now, in the past, President Trump has repeatedly criticized the Fed for not lowering interest rates fast enough. And this move to oust Cook is seen as part of his efforts to gain more influence over the central bank. NDTV's Disha now joining in with more details.
The battle between US President Donald Trump and the Fed is heating up. With just days after US President Trump threatened to fire, in fact said that he's firing Fed Governor Lisa Cook, now Lisa Cook has hit back. First by saying that he doesn't have any jurisdiction, in fact, to fire her. But secondly, now filing a lawsuit against the Trump administration, suing him in an attempt to block her firing. Now, what is the Trump administration really saying, and what is their justification behind trying to fire Lisa Cook? Now, the Trump administration says that it is because of her certain mortgage fraud regarding 2 properties that she owned. But Lisa Cook has clearly said that there are no grounds for her to be fired. But this really brings up bigger questions about the independent nature of the Fed, and it really threatens it, given the fact that earlier US governments and administrations, they don't really have jurisdiction when it comes to firing any Fed officials. But now with the Trump administration trying to fire the Fed Governor Lisa Cook and trying to appoint another person who might be more favorable of the Trump administration's policies, really brings the independent nature of the committee into question. And in fact,
thanks for that, Disha. And from big retailers to small businesses, NDTV Profit takes a deep dive into how the festive season is giving a boost to local economies across India. From sweet shops overflowing with modaks to bustling flower markets and vibrant sari stores, the economic buzz is palpable. NDTV Profit brings you an inside look at the festivities fueling business activity and driving consumer spending. Let's take a look.
We are currently standing in Matunga, where on every corner celebrations of Ganpati Chaturthi are going on, and as you can see, Josh is very high. And while we witness these celebrations, we are also going to be bringing you how the small businesses of Mumbai are bracing themselves for a consumption boost. For example, your local sari walas, sweet shoe owners, and as well as more and more consumers coming in heavy numbers, and worshippers celebrating the festival with a lot of josh. So let's see how these celebrations continue to unfold. Firstly, I would like to understand what kind of footfall do you see on days like this?
On days like this, so footfall is near about 800 to 1,000 people a day, approximately.
And what kind of sweets are they more interested in?
So basically it's a festival season of Ganesh Chaturthi, so more of modak, and we have more than 83 varieties of modak, probably the highest in Mumbai. Nobody must be having that kind of modak. So there are Kaju modak, Malai modak, flavor modak, fancy modak, fusion modak, chocolate modak, ukdi modak, all sorts of modaks.
And will this footfall continue for Diwali and festivals that are coming after that as well?
Yeah, of course, the footfall is going to be good until at least March, so now there is Ganesh Chaturthi, then there is Dussehra, Diwali, and post there it will be followed by the wedding season.
And so what kind of preparations do you do on your part before the consumer numbers increase?
So we stock up the raw material, of course, as it's a perishable product, we cannot stock it well in advance. So on the day, the work starts early in the morning and it is freshly prepared. We have our own manufacturing unit, so all the products are in-house and freshly made.
एक हार बनाने में आपको कितना टाइम लगता है बड़ी मूर्ति का?
बड़ी मूर्ति का 1 घंटा 1.5 घंटा लगता है।
अकेले आप बना लेते हो?
अकेला बना देंगे।
और कितने का जाता है एक बड़ा हार?
बड़ा 8,000, 5,000, 6,000 वो हिसाब से 15 फुट 20 फुट वो हिसाब से बना के देंगे।
किस तरह की साड़ियाँ फेस्टिवल में ज्यादा बिकने लगती हैं?
सब ट्रेडिशनल साड़ीज ज़्यादा बिकती है। ये महाराष्ट्रियन शॉप है, महाराष्ट्रियन के हिसाब से सब ट्रेडिशनल साड़ीज ज़्यादा बिकती है।
फेस्टिवल से कुछ दिन पहले या फेस्टिवल के टाइम पे कितने पीस जनरली बिक जाते हैं और फेस्टिवल के बिना वाले जो महीने होते हैं उसमें एक दिन में कितने पीस बिक जाते हैं?
देखो कस्टमर का फ्लो, जैसे जैसे कस्टमर आते हैं वैसा साड़ीज का सेल हो जाता है। तो समझो 500 पीस महीने में बिकता है, विदाउट सीजन में समझो 200 पीस बिकता है।
आपके खुद के रेवेन्यू पे भी कितना फर्क मान लीजिए, अगर आपने इससे पहले के कुछ महीनों में इतनी कमाई करी तो कितना परसेंट या कितना प्रतिशत तक बढ़ जाती है फेस्टिवल के महीनों में?
समझो ना, अभी ये सीजन में अभी हम लोगों ने फेस्टिवल महीने में आपको 4-5 लाख का फर्क गिरता है। फेस्टिवल जब आता है तो 4-5 लाख रुपया बढ़ जाता है।
And for our final segment, to top it all off, we are here in Ganesh Gali at Mumbai Charaja. And as you can see, festivities are ongoing with full force and devotees are coming here in large numbers to offer their prayers to the idol. And as the festivities continue, we would urge you as well to go and celebrate the festival with your family. That's all in this segment of NDTV Profit. Keep watching.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Well, the US has imposed 50% tariff on India, and with this tariff kicking in, the textile sector is expected to be one of the most impacted because of this. Now, to discuss the same, we are today joined by Pallab Banerjee, the MD of Pearl Global. So, sir, in FY25, if you look at the exports to US from India of textiles stood at close to $25 billion US, and with this 50% tariff kicking in, what has been the early impact of the same on the industry? Have exports from India halted to the US?
So, it has not halted as of yet. But what's happening is the current production, which was already happening, because if we talk of garments, especially the apparels, it's a fashion product. So it's done season-wise. And this is the time when India, normally, or across the world, US actually places the spring and summer products at this point of time, which are supposed to be delivered in the month of November, December onwards. And it reaches the store, that means it's on sale in the month of February, March onwards. So this tariff, the timing of the tariff has come in such a point of time that this new order booking is definitely under pressure. The retailers and the brands of US who buys from US, almost $6 billion of apparel is going out of India. So they cannot absorb this extra 25% of tariff. In fact, if you look at it from the competing countries like Bangladesh, Indonesia, Vietnam, and all the other countries who manufacture apparels, India is at 50. So that makes a gap of almost 30%. And the penalty that we're talking about out here on top of our existing 25 is another 25. So both ways, if you look at it, India is not competitive by approximately 25 to 30% additional tariff. Now, if this is the impact which the retailers and the brands cannot absorb, so they are putting two conditions on the apparel manufacturers of India. Either to absorb this tariff, that means like we reduce our selling price by almost about 16% to avoid this 25% tariff. If you do the maths, like whatever we are shipping out at a lower price by 16%, after tariff would be same if this 25% tariff was not there. So they want that kind of price reduction, or they are pushing us, like for example, Pearl Global, the company that I'm representing, is we have manufacturing across the globe. We have in Bangladesh, Vietnam, Indonesia, and Guatemala, as well as India. So for a company like us, they're pushing us to shift the US manufacturing to other countries. Or if we're doing it out of India, then we somehow absorb this tariff burden. So that's where we are sitting. And yes, the people like who are not able to do either of these, they are going to lose the business. So this is what the situation is at this point of time.
Right, sir. So are you suggesting for the sector as such, as a whole, that 25% of the tariff is something that US clients are ready to bear, but the additional 25 they are asking the Indian exporters to bear at this moment?
Yes, that's correct. Well, first 25%, because if you see, all other countries are in the range of 19 and 20%. So the difference is less, 5%, although like India will have a, uncompetitive by about this 5%, which even it can work out. If India-specific product, which is easily available in India, but is difficult to make in other countries, so that 5% can be shared between the two businesses, the clients and the manufacturer or the supplier from India. But when you talk of a 20 or 30% difference, then it is not possible. So this is what the situation, how it is being played.
Right, sir. As you were mentioning that the other Asian countries have a lower tariff, but what about China? Do we still have an edge over China? And what is the loss of share that you're expecting can happen if this penalty of 25% continues for a long time?
So you see, like, Indian industry was expecting that most of these, or not even Indian industry, but also the US industry, was expecting that China as a country, like, who will have to bear more penalty. And they were getting ready to shift a lot of business into India, because the whole China plus one that we have been talking about or hearing from US and other countries. So now what has happened is suddenly after this final tariff of, which is kicking in on 27th of this month, that's yesterday, India product attracts a 50% tariff, additional tariff over the MFN, which you used to pay, every country used to pay. And China has to pay about 30. So India is in a disadvantage from China today, even with this latest tariff. Because China got an extension for this 90 days, which India didn't get. So in that situation, India is now at the highest level along with Brazil for tariff into US.
Right, sir. And right, you can continue, sir.
Oh, you had a second part of the question. Sorry, I missed that. Can you repeat the question?
The second part was on how much loss or market share loss are you expecting for Indian exporters compared to other Asian exporters and China if this tariff continues?
So China has been very, very competitive, despite the tariff which was placed on China by the earlier Trump administration when he was there in 2016 to 2020. And now again at 30% and less than, even let's say consider that India is 25 and China is at 30%. In that situation, China will be able to absorb because that country, there are a lot of these benefits that the government is giving to the exporters, specifically to generate more of, because their economy is all export-led economy. So because of which they have been very, very competitive in the US market. So what we expect is that at this point of time, if India remains at 50% for, let's say, even for 3 to 6 months, I fear that India will lose a major share of this business. The 6 billion may come down to hardly about 10 or 15% will remain in India. Because why am I saying this? Businesses, big businesses like ours and others, some of others, we may absorb this for one season, but cannot be prolonged to absorb because none of the businesses are having this kind of margin to continue like this. So that's the biggest fear at this point of time. So we are looking forward to some kind of solution. In fact, I heard Scott Bessent, the Treasury Secretary, yesterday said that the discussions are on between India and the US, and we should have a solution soon, right, I guess.
Right. Yes, there have been multiple discussions, and as you were mentioning that yes, margins are at a single digit for most of the players in this industry, so it will be quite difficult for them to bear the brunt. But I just wanted to understand here, has the industry, or is there any talks between the industry and the government, any kind of subsidy that is expected to come in to protect the industry at this moment, given the fact that textile is one of the most labor intensive sector at this moment, and if India continues to lose the business, it would be quite negative for the jobs industry as well.
Yes, because textile industry or the garment industry definitely employs a lot of first generation of workforce if it comes from farm or from home to work. And, operator working in a garment factory can be trained in a period of maybe 30 to 45 days, reasonably well, so that he can start, she can start work on it. And also it employs the maximum number of women. So definitely it's important to India to have this sector. The government is definitely engaged with the various export promotion councils at this point of time to see what are the benefits that can be brought about. So we do expect and hope. But the most important part is that whatever has to be done now, immediately. If it is done after 3 months, we will lose a huge share of market. And to bring that business back into India will take many years. So that's the important part because, like this particular sector works season after season. So we are at this point of time, spring, summer is the peak season for the Indian manufacturers. And if we lose this at this point of time, and if these US customers find a home in other countries for this same product, then to bring it back into India would be more difficult.
Right, sir. So as you were mentioning that you have plans in various other countries, so you would look to shift your production from India to other countries, how much ever exports you're doing to US. Just wanted any ballpark number if you have for the $25 billion of exports that currently India is doing to US, how much of this could be shifted to other countries?
This 25 includes many categories of product. So if you look at only apparel or the garments, that's approximately about 6 billion. Then we have textiles, then we have let's say the home furnishings. So it's a whole gamut of product which is talking about this 25. So I can give you a specific reply for the $6 billion, and also like as you said, like what is my company is doing. So what we are doing is that we do not want to lose any market share from our customers. So naturally, like the same product, if it is shipped out of India or manufactured in India, it attracts this additional penalty tariff. And that's if the customers are not willing to pay, then I have to make those production in other countries like Bangladesh, Indonesia, Vietnam, or Guatemala. So that way, like I will retain the customer. And then when this tariff is removed, then I can bring that product back into India. That gives me one more challenge, which is what is to happen now. The factories and the employees that we have now working, so what will happen immediately? So that's a big concern. We do have almost about 50% exposure of our total turnover into US market, and India is about 25% of our total top line. So that means if you see like almost 12.5% of our total top line is at this point of time at risk, which is placed in India. So this business have to be replenished by some other goods, other customers for markets like Australia or Japan or European Union and UK. So these are the places that we would be looking into. UK and European Union had a FTA, which are basically a free, almost duty-free agreement with some other countries, our competing countries as well. So India was not so strong in these countries, whereas Japan and Australia, we enjoy an FTA. So that means we are as competitive as any other country. So that's something like as an industry, I have to look into. So yes, Pearl Global is definitely more ready, I would say, compared to some other players who might have a very high exposure into US. So that's the big concern that India and the government and the industry bodies or the councils have to immediately address. So that's the situation on ground as of now.
Right, sir. Just one last question here. Assuming the 50% tariff continues for India for some more months going forward, then are you confident, or do you think that Indian exporters will be able to make up for the business loss from US by exporting to other countries, the countries that you were mentioning? We have FTA or other emerging markets as well.
So the problem with emerging markets is that it doesn't have the scale and it doesn't have the price points. So US is attractive. That's why, like, US and European Union, these are the two big markets, which has got the size and the depth. European Union, definitely it's many countries, but US is one single country, and the brands and the retailers are quite substantial and very well organized out there. So that definitely is more attractive for the Indian manufacturers and other countries' manufacturers to supply to US. Now, if you take out US from this whole equation, then it's definitely challenging because the margins and the scale and the volume that is there may not be existing in other. I think comparison you can talk about is European Union, followed by UK, and followed by, let's say, Japan. Then comes Australia and all other countries, like whether it is the big countries or if you go to the South America or African countries. So those are like still not in comparison to the attractiveness of these markets. So that's the reason, it's a challenge at this point of time. And anyway, like if you want to build it up, it takes time. For example, Japan always look for zero defect kind of product. So the infrastructure that is needed has to be higher. So we as a company have been working on it for the last 5-6 years. So now we have a reasonable equation with Japan. But again, to scale it up from where we are today to make the full capacity of India into these markets will take a little time. More about, I would say, a timeline of at least about a year. So the challenge is immediate. What happens to the next 6-8 months? This is for Pearl. And if I talk of, in general, the rest of the industry, if this readiness is not there, most probably the immediate solution would be to shut down or to scale down. So that's the biggest worry.
Right, sir. Well, thank you, sir. Thank you for joining us and explaining the impact of this 50% tariff on the industry and Pearl Global currently.
Let's get him in, Mr. Jalan, Managing Director, Ramkrishna Forgings. More importantly, viewers, a veteran in this space who has looked at multiple such cycles. Mr. Jalan, I dare say, is this cycle or is this piece of this additional 25% punitive tariffs and the uncertainty around it very different from any of the past cycles that you would have seen?
Yes, I think obviously this tariff is one thing which we had never imagined also when we started our exports. And I think this is punitive measure, I think, but all said and done, it's, I think, part of business cycle. And it's going to go away. I think we are very hopeful that in coming months or days, maybe that because US does not have a capacity to manufacture forgings as low cost country, and I think it will sooner or later realize, and this punitive measures are going to go away.
Mr. Jalan, when we were talking to some of the textile companies or one gems and jewelry company unlisted, but in this space, they were talking about some uncertainty as things stand around order bookings post the next 3 months. What is your experience, sir, in terms of your conversations with your key clients in the US? What are the conversations looking like?
No, I think we don't see any uncertainty in terms of new order book or new order wins or new RFQ getting floated. Right now, the demand per se is on the lower side. And I think because of this uncertainty, the overall demand in the US economy is down in terms of passenger vehicles or trucks. The overall demand being down, that's the reason we are seeing less offtake. Otherwise, in terms of pulling out business or shifting business, we don't hear or see any incremental news coming out of US for us. Or I think I can say for entire automotive segment, I don't think there is an alternative to India in terms of the auto component sector.
That's interesting. No alternative to India as well. Mr. Jalan, good morning. Hiral on this side. So let's understand. I mean, when you talk about RK Forging as well, the company has substantial exposure with regards to the North American market, right? And this particularly comes in from the commercial vehicle components which are used in Class 8 truck orders. Now, the question is your Class 8 truck orders is already under pressure over the last couple of months right now. It has been dwindling. So you're already seeing that kind of an impact that does come into companies like yours. Now, secondly, when you talk about the tariffs as well, the other aspect everyone is talking about is alternative routes in terms of other countries, which you can look at. Or secondly, looking at diversification in different sectors. What is the strategy that Ramkrishna Forgings is going to look at?
No, we are not looking at any diversification in terms of our manufacturing facility is concerned. We are doing well with our customers, and I think we have been able to, in past couple of months post the announcement of tariff, been able to negotiate with most of our customers in terms of pass-through of the tariff quantum. And I think we are well on track in terms of our new order wins and new sectors within North America. So I don't see that as a challenge. Right now, the biggest challenge which we are facing it is on the demand side. I think with all this tariff and uncertainty, the demand within US for all kinds of vehicle, whether it is, it's not limited to trucks or Class 8. It is sectors as a passenger vehicle or light commercial vehicle. Every sector is showing a downward trend. That is what is challenging for us. In terms of tariff, I think it is a cost impact, but it is a cost impact for the customer. And we are trying as best as possible to become more competitive in terms of doing more value engineering and doing all sort of engineering to reduce the cost of the product. But in terms of tariff, it is a pass-through for us.
Okay, so tariffs will be a pass-through. The other question I have is...
Sorry, Hiral, if I can just ask in one question. Mr. Jalan, appreciate it's a pass-through, but will there be takers for a higher-priced auto component product from India? I heard you say that there are no alternatives to India, but will there be takers if indeed the pricing is so high?
So I think that's my answer earlier also. They don't have an option.
Alternative. Okay.
I think within US, I think you don't have a manufacturer, and in terms of auto tariff, it is uniform for all the nations across the globe. So 25% tariff is what everybody pays. The additional 25% tariff which has been announced is not applicable for auto components. So obviously we are limited to this 25%.
No, so Mr. Jalan, So Mr. Jalan, one clarification over there, on the back of what Neeraj asked you, is there any supplier that could supply from Mexico as well? Because that has been taken as an alternative when you talk about auto components. And number two, when you talk about auto components as well, the tariffs do range from 25% to 50%, right? There are some components that do fall under the 25% bracket. There are some components that do fall under the 50% bracket. So anything that any clarity that you have on that front as to which are the components that fall under the 25% bracket, which are universal across the globe and which do come into the 50% bracket?
So in terms of my company, I can say all my auto component exports fall under 25% category, and there is no export which falls under 50% category for auto components. Only forgings which fall under 50% category are non-auto forgings, which is particularly goes to oil and gas. So that is one sector wherein 50% tariff is applicable. And that is not today. That is the day oil, steel and aluminium tariff were announced as 50%. That tariff has been applicable. This 25% punitive tariff, which has been announced later on, is not applicable to any of them. So from day one, we knew the 50% and 25% auto tariff, 50% is for steel and aluminium, and 25% is for automobile.
So Mr. Jalan, would it be right to say that because 25% is a universal tariff across the globe, with regards to where auto components go, I'm talking about forgings, everyone's competitiveness continues to remain the same as it was, because they will see a similar kind of price increase, that cost competitiveness, so not major things that change around then?
Yes, I think that's right. I think that is what we have been always telling, that it is going to be day as usual for everybody has to ultimately go and pay this tariff, except for Mexico and Canada. But both these places also buy forgings. Today, out of my North American export, 80% of my forgings go to Mexico. So basically, the forgings which go into Mexico are converted into finished goods, and then they enter to US. So obviously, Mexico also does not have any large forging facility. So I don't think any pullback of order is going to, or we are going to see any cancellations of order. Whether it is limited to our company or whether it is limited to India, we don't foresee any major setback in terms of orders and inflows of new orders.
Got it. Okay. Mr. Jalan, just trying to bifurcate this for the portion of the tariffs. Sorry if I'm repeating this, and sorry if I have to repeat it, but just wanted that clarity. For the portion of the products which might be subject to 50%, would there be takers at that higher price, or you reckon the supply chains might get shifted?
So, like I said, whatever tariff is applicable at 50% is majorly for oil and gas and non-auto components,
right,
which fall under steel and aluminium. So that 50% steel and aluminium, 50% is applicable throughout the globe. Nobody has been given nobody has been given an exemption for this 50% for steel and aluminium.
Got it.
Whether it is China or anybody. So I think everybody will need to ultimately pay, other than creating a new manufacturing within US.
Got it. Okay, just one more question, Mr. Jalan, from my end at least, and which is just the natural course of diversification that any business would want to do, and maybe that gets heightened, not because there is a tariff that is looming, but because of the nature of the conversation that has happened with other sectors, that you might want to diversify away from a point of concentration into other areas. Are you contemplating that as well, Mr. Jalan? You're not hit by tariffs, but you may still want to do it as prudence.
I think as prudent, we took this effort, I think 2 years back itself, when we started looking at more and more businesses from Europe and other places, Southeast Asia and other places. And I think we are working very diligently and very focused way in creating a parallel North American business platform within the Europe. And I think we are not far away. I think we should be in next 8 to 12 quarters reaching there, wherein our European operations or European businesses is going to be equal to or bigger to North American business.
Right. Mr. Jalan, and when you're talking about, the demand as well, I was just looking at the Class 8 truck orders, and it's actually reached a 16-year monthly low, while medium duty orders are the weakest since the outset of the pandemic. Now, even FTR, they've indicated that these numbers are coming in and this, it's seeing this kind of a downtick mainly on the back of tariffs. And secondly, the freight rates, everything is becoming a concern. Now, if this is the scenario that will continue, what is the kind of impact you will see overall in terms of FY26 and FY27? Because Class 8 trucks also is one of the biggest aspects that you actually supply to.
No, I think if you see the August numbers which have come in the month of September, I think this has shown an uptick versus July, and that brings an optimism. I think with all these tariff issues right now behind us, I think people will now start living with tariff. I think the way forward, people will need to understand the way of life is tariff is not going to ever end. So I think it's going to be at some point of time, there is going to be an inflection that we are going to get back to normal. We are not seeing peak, but we are going to get to normal of 16,000 vehicles a month. And I think maybe in next 3 months, maybe in 6 months, that's going to be there. But in terms of RKFL, I think with the new business wins within North America, already starting to create revenue. And also within Europe, we are seeing in next 6 months to create revenue. I think we should be, I think we are looking at in next couple of months, worst days to be behind us. And I think we are going to be back on our track of growth.
It's going to be interesting. 16,000 in the next 2 to 3 months. If you talk about Class 8 truck orders, that is an absolute rebound that the street would see as well. But thank you, Mr. Jalan, for being patient and speaking to us. Yes.
That is an optimism an entrepreneur has to stay with.
Absolutely. Optimism is what is the need of the hour right now.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
As a child, I enjoyed playing tennis, so I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
Good evening, you're watching The Big Question. I'm Sanjana. What started as a hopeful promise to dramatically boost US-India trade quickly spiraled into one of the toughest tariff challenges that India has faced in recent memory. Now this evening, what we're going to do is unpack the unfolding story behind the tariffs, how geopolitics turned the tables, with Russia punished, China contained, and India pressured as a rising power in the Indo-Pacific. We'll explore the immediate impact on India's industries, the cushioning effect of domestic reforms like GST, and broaden the lens to contrast India's treatment with US policies towards other global players like Russia and China. Because viewers, as India stands as this very critical crossroads, this conversation needs to dig deep into whether these tariffs represent a crisis to be feared or a catalyst for urgent economic recalibration and strategic resilience. Let's get right into it. What began in early 2025 as an ambitious promise to turbocharge the US-India trade has quickly turned into a defining economic standoff. Prime Minister Narendra Modi's pledge to double bilateral trade to $500 billion by 2030 clashed with tough American demands over tariffs and market access, igniting one of the most severe tariff crises India has faced in decades. From an initial 25% duty on key Indian exports to a staggering 50% tariff wall, India's labor-intensive sectors now face unprecedented pressure. Amid diplomatic tension and stalled talks, India is responding with resilience, expanding export missions, protecting farmers, and standing firm against what it calls unfair treatment. This is the timeline of optimism fading into confrontation and how India is preparing to meet the challenge head-on. Let's take a look.
What began in early 2025 as a promise of booming US-India trade instead turned into one of the toughest tariff challenges India has faced. Here is the timeline of how optimism gave way to escalation and how India prepared its firm response. In February 2025, the mood was upbeat. Prime Minister Narendra Modi pledged to double bilateral trade to $500 billion by 2030. India offered to buy more American energy and sought to cement its role as a global manufacturing hub. The US welcomed the intent but remained critical of India's agricultural and industrial tariffs. But by March, cracks had appeared. Commerce Minister Piyush Goyal travelled to Washington to meet US Commerce Secretary Howard Lutnick, and the talks stalled over agriculture. Soon after, the US Trade Representative's annual report branded India one of the most restrictive markets, signalling that tougher measures could follow.
जब भारत के इंटरेस्ट को संरक्षित रखते हुए नेशनल इंटरेस्ट विल ऑलवेज बी सुप्रीम, वो ध्यान में रखते हुए अच्छा अगर डील बनती है तो भारत तो विकसित देशों के साथ डील करने के लिए कभी भी तैयार है.
In July, the first tariff strike came. On July 31st, President Donald Trump signed an executive order imposing a 25% duty on $48.2 billion worth of Indian exports, including textiles, gems, and seafood. He warned that if India did not make concessions, another round would follow. By August, the escalation was complete. On August 6th, Trump announced a second 25% duty, effective August 27th. The combined 50% tariff hit $60.2 billion worth of Indian goods. India's foreign ministry called the decision unfair and unreasonable, but New Delhi stayed firm. The tariffs weigh heavily on India's labor-intensive sectors. Diamonds in Surat, textiles in Tirupur, seafood exports from Kerala and Bengal, and leather manufacturing. These industries employ millions, and India now faces one of the highest tariff rates in the world, comparable to Brazil, while partners like South Korea pay just 15%. India did not stay passive. In late August, the government unveiled a 25,000 crore export promotion mission to push into new markets in China, Latin America, and the Middle East. Prime Minister Modi promised to protect farmers and small businesses even as the US cancelled a scheduled August 25 to 29 delegation visit, leaving trade talks in a limbo.
मेरे देश के लघु उद्यमी हो, किसान हो, पशुपालक हो, हर किसी के लिए मैं आपको बार बार वादा करता हूं, मोदी के लिए आपके हित सर्वोपरि है.
From the hope of a 500 billion trade partnership to the reality of a 50% tariff wall, India's exporters face a challenge. But with diversification plans and firm leadership, New Delhi continues to stand its ground.
As President Trump's 50% tariff on Indian goods takes effect yesterday, analysts are warning that this drastic move could shave off 70 to 80 basis points from India's GDP growth. Now, the sectors expected to bear the brunt include textiles, gems and jewelry, seafood, chemicals and leather, industries that employ millions and are deeply intertwined with the US market. My colleague Somit now joins us with a detailed breakdown of the specific impacts and how India is responding to this escalating trade challenge.
Well, yes, if you look at India, US is one of the largest trading partner for India. Around in FY25, we exported goods worth around $86.5 billion to the US market, which is nearly 2.2% of the GDP. But we also need to remember that not entire of this export come under the 50% tariff. Just 67% of India's export to US come under this 50% tariff, which comes to around $58 billion, which is around 1.5% of the GDP. The remaining of the goods come under Section 232, and some analysts believe that this 50% tariff could lower the GDP growth by around 70 to 80 basis points going forward. Some goods that not come under this category or are exempted from the 50% tariff or the additional 25% tariff are auto and auto parts, iron, aluminium, steel, copper and its products, pharma, and when it comes to electronics, the goods that are exempted from the additional tariff is chips, mobile, tablets and PCB. So let's now look at the sectors that could get impacted because of this. Firstly, auto and auto ancillary companies have a high exposure towards the US market. For Sona BLW, nearly 40% of the revenue came in from the US market in FY24, followed by RK Forging, Bharat Forge and Tata Motors, which had around 23 to 25% of the top line coming in. For Samvardhana Motherson, 18%, for Balkrishna Industries, 18%, for Sansera Engineering and Apollo Tyres, around 3 to 9% of the top line came in from the US market. But again, do remember that these companies have plants in other countries and other nations as well, and they could shift this supply which has been going from India to those countries, and the impact could be lower for the actual impact could be lower for these companies. For UPL, for chemical companies, it's UPL which has the highest exposure, around 25% comes in from the US market, SRF 20%, Jubilant Ingrevia 9%, but these are the companies that have actually mentioned their US exposure. But apart from that, there are a host of companies that export to US market like Aarti Industries, PI Industries, Atul, Navin Fluorine, Deepak Fertilizer, Vinati Organics, Alkyl Amines and Gujarat Fluoro. All of these companies have some or the other way exposure to the US market. When it comes to the textile sector, that is the sector that could get impacted the most because US accounts for nearly 28% of India's textile exports. and the companies that have the highest exposure here, firstly, it's Welspun Living, nearly 63% of the top line comes in from the US market. Trident gets around 38%. KPR Mill gets around 19%. Apart from that, it's Himmat Singha, which gets around 83% of its revenue from the US market, while Alok Industries and Arvind getting close to 37 to 45% of the top line. Then there are seafood exporters, shrimp exporters and shrimp feed exporters. Avanti Feeds gets around 14% of its revenue from the US market. Apex Frozen Food and Waterbase get around 40 to 60% of the top line from the US market. When it comes to consumer goods, not many companies, some rice exporters have some exposure. LT Foods, 39% top line comes in from US. KRBL and Tata Consumer get around 10 to 12% of the revenue from the US market. When it comes to the energy space, no impact on energy producers, but some impact that we could see on the solar PV module manufacturers because Vari Energies here has nearly 57% of the order book coming in from the US market. Premier Energies, on the other hand, just has 1% of the order book coming in from the US market, but they had plans to go big or expand in the US market, so that could get impacted for the company. When it comes to the oil and gas space, no direct impact, but if India goes ahead and reduces their crude sourcing from Russia, that could increase the crude cost for the oil marketing companies and Reliance as well. Currently, they are getting a discount of $1.5 to $2 per barrel, so that could go away and increase the crude cost for Reliance Industries and OMC. And on the EBITDA front, if you see the impact for Reliance Industries could be around 3% and for oil marketing companies, the impact could be as high as 10%. But these are the companies that or sectors that get impacted. But on the flip side, there are multiple other companies or sectors that stand to not get impacted because of this Trump tariff. IT services, FMCG, telecom, real estate, all these three sectors have more than 90% of the revenue coming in from the domestic market. Apart from that, banks, insurance, power, steel and capital goods, most of these sectors have nearly 90 to 95% of the revenue coming in from the domestic market and are kind of Trump-proof sectors at this moment.
Thanks for that, Somit. And another sector that could face significant impact is gems and the jewelry industry. And in fact, my colleague Harsha from NDTV went to the Jaipur Gems and Jewelry Hub and brought us this on-the-ground report highlighting the challenges that the sector now faces. Let's take a look.
Gems and jewelry is the highest revenue earner for Rajasthan in terms of foreign exchange, much more than tourism. In fact, 18,000 crores are the estimates that the gems and jewelry business earns in Jaipur. And of that, about 3,200 crores is the US market, which is about 20% of the total export. I have with me Alok ji, who is the president of the Jaipur Jewelers Association. Alok ji, क्या लगता है आपको what is going to be the fallout अगर इस तरह से if the tariffs have already come in, they've already kicked in, so now how is it going to impact the business? I mean, it's the biggest foreign exchange earner for Rajasthan.
It's a major disruption that we are going to see now, and the effect is, as we see today, if things are not sorted out in the near future, there will be a lot of pain, and that includes the businessmen, small, medium, large, doesn't matter, even, and the artisans. Once this cascading effect goes down and people start leaving this industry, then it will be very difficult to just gather them back together.
Alok ji, आपका जो business है, how much of it is driven by America actually? कितना percentage? और किस type का जाता है? आपने बताया कि finished jewelry भी जाती है and there's some loose gemstones.
Yes. So we are majorly into jewelry exports, studded jewelry exports, and about thankfully we are not so much into American market, but still about 10 to 15% of our exports are to America. So that is what we are seeing. It's the season is coming, but what we are seeing is this will be zero this year.
Also, this segment employs at least 2 to 3 lakh labor in Jaipur alone, and they're going to be severely impacted. In fact, a lot of the labor who work here are from outside Rajasthan. आपका नाम क्या है? हाँ,
सेतवान.
हाँ, कहाँ से हैं आप?
यूपी.
हाँ, तो जो जैसे ये बात हो रही है कि भाई अमेरिका ऑर्डर देना कम कर देगा, तो फिर डायरेक्टली प्रोडक्शन हाउस में ऑर्डर कम होएगा, तो फिर तो कारीगर पे तो इम्पैक्ट आएगा ही ना?
आएगा.
हाँ हाँ. क्या चिंता है?
चिंता है घर परिवार अपना हम कैसे चलाएंगे. इसी से कमाते हैं तो अपना खर्चा चलता है.
I have with me Sudhir Kasliwal. The Gem Palace is one of the oldest shops in Jaipur. But Sudhirji, with the kind of tariffs that we are seeing, the new administration, Trump administration, you also had made inroads into the export market. You were also sending jewelry abroad. You were not just doing traditional jewelry. How badly has that been hit?
You see, almost 60 to 70% of our export orders have been kept on hold lately after the Trump tariff announcement.
What are your customers saying about that? I mean, they must be with you on email. What is the concern?
The concern is increase in cost because they are wholesalers and they are also going to sell it to their customers and they must have quoted a price. We have also quoted a price. So the price hike definitely will affect their sales also, and our sales are being affected for sure.
So 60 to 70% of export orders is a huge hit for any business to take. Also, Jaipur is also a thriving tourist industry. And a lot of tourists who come here also come shopping. They come to buy gems and jewelry. In fact, it's always on the shopping list of every tourist who comes in, especially the upmarket tourist. So will they also be affected? Do you think domestic sales to tourists, foreign tourists will also be affected?
See, our sales are mainly to foreign tourists. And out of all the domestic, the foreign travelers coming to Jaipur, our sales are almost 70 to 80% to American tourists. They are our big buyers. Now, that is also going to be affected because that we'll see in the coming season, because now it's not a tourist season, but it's definitely going to affect our business.
So that's how the cascading effect of the Trump tariffs will slowly be visible in the Indian market. But for now, the Trump tariffs have sent tremors down Jaipur's jewelry business, and it's threatening to take the sheen out of what was once a glittering business for both import and export.
Right, thanks so much for that, Harsha. And earlier today, I also spoke with Michael Kugelman, a leading foreign policy expert specializing in South Asia, and we discussed what this means, India's role on the world stage, its industries, and of course the broader Indo-Pacific balance. Let's listen into that conversation. Increasingly, tariffs aren't just about economies, but they're also about geopolitics, and that's something that we've actually noticed since February. From your vantage point, how has Washington used tariffs to discipline or contain adversaries like Russia and China, what we've seen?
Well, not only that, it's also using tariffs as a way to pressure and indeed punish partners like India. And this is not something that we frequently see in U.S. foreign policy. But then again, with the Trump administration, there's a lot we're seeing with foreign policy that we don't typically see. And if given the stakes of U.S. trade relationships with a number of the countries that it's put tariffs on, including India, it certainly is a big gamble, a big risk for the U.S. economy. And we talk about the damage that these tariffs could have on those countries that are targeted by them. But the U.S. itself could suffer from this strategy of injecting geopolitics into economic policymaking.
All right. So would you say when it comes to India that tariffs are a pressure tool or more of a bargaining tactic by Washington? Because we've seen that actually take place, but India seems to have a pretty firm stance now recently.
Well, I think it could be both a bargaining tool and a pressure tactic, but I think more the latter. We've seen that the Trump administration really hopes and expects that countries will essentially make all the concessions that the administration feels it needs in order to get a deal. And India has made a number of concessions, but it has put its foot down, of course, in some cases, and that prevented the U.S. from getting a deal with India. And the tariffs that we're now seeing, the 50% tariffs in India, certainly the proximate cause, the proximate explanation from the administration is that it wants to essentially, pressure India into backing away from Russia to compel Russia to agree to a ceasefire in the war in Ukraine. But I think we have to look at this in a broader context as well, looking at these U.S.-India trade talks, which are not off, but are certainly not in a good place right now. The Trump administration is still looking for India to back away and ease protections in some of those very sensitive sectors like agriculture and dairy, wants India to make those moves, whereas I think it's highly unlikely that India will actually make them, especially if it keeps getting these pressure tactics in the form of tariffs and other steps as well.
Right. I'm going to now shift gears and make this a little more about the industry impact and the focus on India, because beyond short-term export pain, which is what the government is anticipating at this point of time, do you see tariffs and the risk undermining investor sentiment about India as a reliable supply chain alternative to China?
Well, yeah, I mean, I would think so, right? I mean, you're looking at a situation of, I think 70% of Indian goods now facing 50% tariffs coming into the U.S. That's a lot of goods, right? Given the nature of the U.S.-India trade relationship. And I think that investors couldn't help but be concerned about that. And I would argue that the private sector, the U.S. private sector, has long been very sanguine about investment in India. I mean, certainly you have investors that are concerned about the investment climate in India, but on the whole, you've seen an upsurge in optimism from the investor community wanting to deploy capital in India. But I think that with these drastic tariffs that have come about, I do think the risk is that will give pause to some investors, and that clearly is not a good thing for the broader U.S.-India commercial partnership.
Okay, so then do you think that these tariff confrontations could accelerate or expedite India's pivot towards trade with Southeast Asia, Africa, or even the BRICS, and potentially strengthen the BRICS some more?
Well, I mean, it's clear that India needs to find more market access. It needs to compensate for what it's going to lose with the U.S. And so there are a lot of options. I mean, you mentioned the Global South, Southeast Asia. Those are certainly places where India could look. But I think in the immediate term, India will look at the places where it has the highest comfort level, and Europe, I think, would be front and center. I mean, as you know, India has been negotiating a free trade agreement with the EU over the last year or so. It wants to get a deal by the end of the year. And I think that given what's happening with U.S.-India trade relations now, the incentives for India to wrap up those trade talks with the EU, I think, have gotten even stronger. If India were to get that deal with the EU, that would be a big help because, as you know, the EU is, like the U.S., a top export destination for India, one of its top export destinations. I think that will be a big priority for India in the immediate term. But yes, I think that in due course, it's going to want to look elsewhere as well. Obviously, if you're talking about the BRICS states, that's another minefield because President Trump has repeatedly said that he will put tariffs on the BRICS states. In some contexts, he's said that for just being members of BRICS, not even necessarily if they were to take steps to try to create mechanisms that are meant to counter the dollar, but even for merely being a member of BRICS. So that would be another risk for India, but given the state of the U.S.-India relationship right now, if India thinks that for commercial reasons it has a strong objective to try to expand trade ties with the BRICS states, so be it. And of course, it already is looking to scale up its already robust commercial relations with one BRICS member, that being China. And of course, it has a very strong partnership with Russia, including a trade partnership, and that's not going to be changing anytime soon either.
All right. So I'm actually going to now focus on what's happening within India, because India's what some experts are calling domestic insulation versus these global shocks. How much of a cushion does India's proposed new GST system and the rising domestic consumption give against these tariff shocks overseas?
Well, I mean, it's tough to say, especially because we don't know how long these U.S. tariffs will be in place. I mean, the administration could cut them down, it could reduce them, even if India does not do anything in response. So I think it's hard to say at this point. But if you look at the overall economic health of India, it's quite strong. I mean, I do note that we've had periods of uneven growth in recent months, but on the whole, I mean, India's long-term growth trajectory is strong. I mean, according to the IMF, it still is the it's the fastest-growing major economy. So I think that these initiatives that you just referred to, Yeah, I think that they certainly would not hurt in the sense that India's economy is resilient because of its strength. So it can be resilient in the face of these tariffs, but we have to see how long these tariffs will last, and we just don't know at this point.
Okay, so let's look at the bigger picture now and how India's treatment compares with US tariff policies elsewhere. Because given India's central role in the US Indo-Pacific strategy, can Washington even afford to lean too hard on tariffs, or will geopolitics always override economic friction?
Well, I mean, in some cases, geopolitics does override economic friction for sure. But I think that in this case, all bets are off in the sense that, we're seeing a Trump 2.0 that's taking a much harder line view than Trump 1.0 when it comes to this issue of pursuing U.S. economic interests. And so now we're seeing a Trump administration that is willing to take maximalist steps, and including pressure tactics, to try to get countries that include its closest partners, including strategic partners like India, to act in ways that reduce risks to U.S. economic interests, and including, according to the Trump administration, India's tariffs, which are pretty high, do pose risks to the U.S. economic interests. But I'll also say this. We talk so much about how a shared interest in countering China is really the strategic glue that holds the partnership together. But, the Trump administration has signaled a desire to ease tensions with China. And of course, India has been trying to ease tensions with China for many months. So in that sense, perhaps the Trump administration feels that at this moment in time, perhaps India doesn't have that level of strategic significance as it has in the past vis-a-vis China. And because of that perception, the Trump administration feels that it could take more risks to try to target India with these pressure tactics, even against that backdrop of that very important strategic environment.
All right. And before I let you go, when we compare India's case with the US's policy towards Russia, towards China, Mexico, Vietnam, or even the EU, what really stands out for you?
Well, I mean, India has been hit harder than almost any other country. I mean, Brazil got similarly high tariffs. China at one point was getting high tariffs, but we're just not seeing this. And I think that many countries did make all the concessions that they needed to make in order to get a deal to ensure that tariff damage would be minimal. And India, of course, was not willing to give in completely. And that's why it's getting this really harsh treatment. And what also stands about India is, of course, how it's been dragged into President Trump's objectives in Russia, right? I mean, no country has been pressured as much as India when it comes to the issue of relations with Russia, right? China, as we all know, imports more oil from Russia than India does, but China did not get tariffs because of that energy relationship that it has with Russia. So, I think, unfortunately, India stands out for all the wrong reasons when it comes to how the Trump administration has gone about these trade and tariff policies with countries across the board, including some of its closest partners.
Right, Michael Kugelman, thank you so much for that very, very comprehensive insight and discussion on this. We'll continue tracking this and how tariff pressures could reshape India's economic and geopolitical landscape. Thanks so much for speaking with us.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations?
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. A very old statement is that when two elephants fight, the grass suffers. And this is playing out in the healthcare space. You have an association of healthcare providers which has decided to stop accepting Bajaj Allianz policies for cashless services. Now, if you are new to the healthcare space and if you're unaware of how health insurance works, this will not make a lot of sense to you, but a lot of people will know that a cashless facility is where you go to a hospital and you don't have to pay out of pocket. Because you have a health insurance policy, they will treat you in the event of a hospitalization based on what you have on your policy, based on the cover that you have. Now, if you are a Bajaj Allianz holder or policy holder, you don't have this available in a number of hospitals, and this is over 15,000 hospitals in India. We'll talk about what you should do if you are a customer, and we'll also use this opportunity to talk about health insurance in general. And joining me is Vishal Dhawan, the founder and chief executive officer of Plan Ahead Wealth Advisors. Vishal, thanks so much for taking the time. Let's talk about the issue first, right? We did speak with the AHPI representative, and they have certain contentions, and of course the company is hopeful of a resolution. I believe that there is some conversation, but it's unfortunate because the customers at the end of the day suffer.
Yeah, I think it is a challenge, because what tends to happen is when you do end up having a hospitalization that takes place, you do want to spend your time focusing on helping with the treatment and the recovery. And very often, making decisions around what's the right course of treatment itself can be very stressful, because there could be alternative approaches that are suggested by doctors. And you need to go through finding the right doctor, finding the right treatment, getting, the ecosystem prepared for all of that. And then on top of that, you have to deal with money matters. Now, what tended to happen with a cashless facility, obviously, is that it tended to allow you to focus on all the other items and do away with focusing on the financial aspect of it, at least to a certain extent. And obviously, because the bill settlement was happening directly between the insurance company and the hospital, some of the more technical questions that could arise when a customer was interfacing could get solved easily, because insurance companies and hospitals could speak the same language. So I think when it does go away, it certainly creates a lot of additional stress beyond the normal stress that would anyway arise in these kind of situations.
It's important to talk about all of the aspects that you've just described in a little bit more detail. And it's a great opportunity, despite the fact that we're speaking about this unfortunate situation, to help people understand why cashless is important, why health insurance itself is important. So, Vishal, in your experience, when you go out in the case of a hospitalization without a cashless service, what is the kind of situation that you find yourself in? Because you have to have money, first of all, available with you, because a hospital, though they're not supposed to ask for this,
will ask for a deposit. If it's not a state-owned hospital, if you go to a private hospital, they can deny you treatment if you don't have the money available to you. Is that right?
Yeah, so typically hospitals will ask for a deposit, to be made available immediately. And obviously what ends up happening is that you have to have access to that money. And this becomes even more critical when you have unplanned hospitalization events. When you have planned hospitalization events, let's say there's a surgery for which you have, gone into talking to a doctor. The doctor said, I plan to do a surgery next week, etc., etc. It's a very different process as compared to when you get into an emergency situation. Maybe it's the middle of the night, and there's been an accident in the family, or there's been a heart situation that seems to have arisen. So I think the approaches can be very different if you're planned versus unplanned. But nevertheless, whether you're planned or unplanned, you need to have money available. And therefore, the important thing that cashless procedures actually ended up doing is very often they allowed you to deal with the planned ones extremely well, and the unplanned ones also reasonably to a better extent, because of the fact that there was already a tie-up between the hospital and the insurance company. I think where a lot of stress gets created by the event itself, I think the financial aspect sometimes can just move that stress to a very different level. And you then need to have money lying around. Very often, you need a credit card, for example, to be able to access to make your original initial payment, or maybe you have liquidity lying in your bank account, so that you can do a UPI transfer. Maybe you have, actually cash available with you, which you can use for that payment. So I think there's a lot of processes involved, but clearly at the start, you need to be putting out some amount of money so that the treatment can happen in the manner that it's supposed to happen.
Yeah, important point. And so therefore, to draw the conclusion from what you've just described, it gets very complicated when you don't have cashless. That should be the first priority, to utilize cashless, utilize a health insurance policy, because it opens a lot of doors for you right up front in the case of an emergency. Of course, in the case of a planned treatment, as you've pointed out, you have more time to plan. But when you're talking about cashless and when you're talking about selecting a health insurance provider, should you be aware of the network of hospitals? Should you be aware of which hospital you would go to in the event of an emergency?
Absolutely. I think there are, some things that are well done or better done when they're planned well. And, you need to plan for emergencies also, as much as it makes it sound strange, because, you would say an emergency is an emergency. So how do you plan for it? But you can do certain things. For example, very often when you have emergency health situations, time is of great essence. And therefore you need to know what are those hospitals that are in your vicinity, which would become your ports of first call. Because you want the treatment to start as quickly as possible. And in certain kinds of treatment, as you'd be aware, there are things like golden hours, etc., in which you need to get to the hospital and start the treatment. What you also want to do at the same time is know that, there could be preferred doctors that you have for treatment. And those doctors may be affiliated with certain hospitals and not be affiliated with other hospitals. And therefore, sometimes your choice of which hospital to go to would also be driven by the choice of doctor or medical professional that you want to deal with. And obviously, if your network of cashless hospitals and the hospital and the doctor that you work with are all in sync with each other, saying that, okay, this doctor is associated with this hospital is a part of the network for this insurance company, then it makes your life much easier because everything is in sync with each other. If not, then obviously there are ways out of it where you go out and do a reimbursement claim because you say that, getting to the hospital was more important than it being a network hospital. I will figure out how to make the payment initially and then get a reimbursement by giving the bills, etc. But I think it's important to think through how this would happen. And I think for a lot of people, they also need to keep in mind that they may have an independent health insurance cover, which may have a certain set of network hospitals, and then they could have a company cover or a corporate cover provided by their employer, which could have a different set of hospitals on it. And therefore, which of those insurance covers are you likely to use would also dictate how this process will work. And all of this is not possible to do instantly when an event happens because you're trying to focus on the patient. And that's why some of this planning in advance, maybe even speaking to family members saying, this is what we are thinking about. Let's say if something happened to me, this is what I'd like you to do. If something happens to you, this is what I'm thinking should be the approach to be taken. Are you okay with it? And I think that way the decisions can be very quick.
Yeah. And time is of the essence, of course. That goes without saying. I will circle back to what to do if you don't have available cashless facility. But to that end, what should people who currently have a Bajaj Allianz policy do? Should they look to port? It's not the easiest thing to do, is it, Vishal?
Yes, I think it's not easy to do it. And what we need to keep in mind is that, by porting, you may not be able to permanently solve this problem because the list of network hospitals, for example, can change over a period of time. So there are hospitals which can go out of a network. There can be other hospitals that come into a network. Similarly, you could end up in a situation where there could be times where a particular insurance company, like Bajaj is facing right now, is not being given cashless. But that doesn't mean that a similar sort of thing could not happen to other companies as well. And therefore, what we need to keep in mind is that this is a moving item. And therefore, for you to be able to continuously port may be hard because today, if you port from Bajaj and go to someone else, you might find that you run into the same problem with another insurance company at some point in the future. So you need to keep in mind that you'll have to do two things parallelly. One is build your own independent emergency fund solution to take care of events of this kind, which can happen. Because you also need to remember that porting can only happen 45 days before your insurance premium is due. And therefore, let's say if you just paid your insurance premium to Bajaj and your next premium is due only 1 year later, then what do you do for the next 9-10 months is the question that needs to get answered. So I think porting may not be as simple a solution as possible. And therefore, you might have to look at the other alternatives to see how this can sort of come through. And that's where, even your company cover could be valuable because a lot of times when we speak to families, they do not have enough information itself about their company covers. They don't know who's the provider, which is the network hospital, who all are covered, to what extent they're covered, how does it work in case there is an emergency. So I think a lot of this itself is missing because somehow it always appears that emergencies will happen to someone else but will not happen to me.
Yeah, I mean, you said it. I couldn't have said it better. So therefore, the point that you've just made, in the case of those people that have these policies, you might have to look outside of the network, right? For those that might just give you cashless. And beyond that also, you might want to build up on an emergency fund or bolster it till this resolution is found. But let's talk about how that is constructed because, Vishal, it's not the easiest thing for a lot of people to do. And I've often asked this question. And frankly, I don't think that I've gotten the best solution here, right? Because if I go to somebody who's 25 or 26 years old and I tell them, look, you're going to have to save 6 months worth of your expenses, they have universally looked at me funny. And they've said, what do you mean? I can't take care of this week's expenses. How do you expect me to set up that kind of a fund? Is there an answer here?
I think it's a real challenge because what ends up happening is obviously when you're younger, your probability of having that emergency for yourself reduces. It doesn't mean it can't happen, but it just is a lower probability. And I think that's where it's important for family structures to be thought about in the right manner. So you could find that there could be families where there are dependents. There could be, parents, for example, who need to be taken care of. In those cases, the question really is that, who's expected to create that emergency corpus? Is it the 25, 26-year-old because he's the only one who has who's the earning member and the dependents or the parents or older are not earning, or have they created their own emergency corpus for these kind of situations already? I think what we find very often is that families are not talking about this enough, either because it's a slightly sensitive area where you talk about things which are unpleasant, like a medical emergency, or it happens simply because everyone's assuming the other person's doing their job and their role. And therefore, there is no consolidated view being taken of this. And therefore, you could end up in a different situation as well, where two sets of people are taking two emergency funds and building it up parallelly. And therefore, as a family, you have too much emergency provisions getting created as compared to what you required. So I think, the thought that you need to take a very nuanced and a careful decision on this cannot be underestimated. I think the way to think about it is, once you've understood dependencies, how much corpuses have already got created, you now start to look at pre-existing conditions. Obviously, there are pre-existing conditions that exist. Let's say there's a diabetic in the family, someone has high blood pressure, someone's had a cardiac history, etc. Then the need for this buffer may need to be larger, simply because the probability of something like an emergency happening could be higher. No one knows whether it will or not, but the probability increases. And therefore, the way we think about it is anywhere between 3 months going all the way up to a year, maybe the tiered approach that families take. And one of the things that we found work well for younger people is that, if you tell them that first create the first 3 months of emergency, I think they don't have the patience for that. But if you tell them that out of every, sort of rupee that you save, can you put a part of it aside towards your emergency fund? And therefore, you keep bolstering this over a period of time. And hopefully, the emergency doesn't come up so quickly. I think the acceptance is much higher when you tear this out rather than try to do it all in one shot.
So to that end, how do you go about it? And where would you put this? Would you put it in different buckets, even within that emergency fund, and use, I know a lot of people use liquid funds. Some people are gravitating now because of tax purposes towards arbitrage funds. I don't know if that's the best idea, because you would want to keep it very liquid, and arbitrage is T plus 1, right? Is it not? Or is it T plus 2?
T plus 2.
Yeah, T plus 2, right? So therefore, you need to have availability of funds very quickly in the event of an emergency. And also, should you put your credit card into that? Because ultimately, a lot of people say that you should go and swipe your credit card in the event of an emergency.
Yeah. So I think there are many different ways that people can use it. And obviously, a lot of this depends on preferred approaches. So for people who have credit cards which have decent limits on them as well, I think a credit card initial swipe is a good idea, because what it does is it gives you access to the money immediately and allows you to focus on the core issue, which is getting the treatment started for the patient quickly. The challenge with credit cards is, of course, if your limits are already used up, or you tend to use this as a more permanent solution rather than just an immediate liquidity solution, saying that, in the next few days, while the treatment is going on, I will find the other sources so that I can pay off my credit card as quickly as possible. I think that's important to be clear about, saying use the credit card first, but use it very prudently and allow it not to roll over, because the cost of the credit can then otherwise be extremely expensive. Now, while this is happening, there are different approaches that people can do for their emergency fund provision. So either it could be a liquid fund, or it could be a savings account which has a linked fixed deposit to it. So there are these accounts which have a sweep in, sweep out facility where the money goes to a fixed deposit and then comes back out of it if needed. There could also be the use of arbitrage funds, like you mentioned, or there could even be investors who are using short-term debt funds, saying that the volatility on the instrument is going to be very low, and I don't know when this emergency is going to happen. So, rather than being in a liquid fund instrument where my rate of return will typically be lower, I'm okay to park a part of it into a short-term debt fund as well. What some people also do is they create credit lines. For example, against a fixed deposit, you can create an overdraft credit line, which will only come into play in case of an emergency. So there are different approaches that people can take, and there is no one size fits all on this because it depends on the tax bracket of the individual. It depends on their own discipline of using that credit line only for emergency purposes and not using it for shopping, for example, saying that for me right now, shopping at Ganpati is an emergency because I need this new wardrobe or I need to travel or some of that. So I think there needs to be a very customized approach taken to the emergency fund without not creating the emergency fund because you're confused. I think our suggestion to people is that if you're confused, give up 1% or 2% of returns and just park the money aside so that in the case of emergency, you have money available.
I love that you said that with such a straight face. The unavailability of clothes in your wardrobe during a festival is an emergency. It certainly is for a few people, but I guess from the perspective of managing your money, the emergency we're talking about is very different. Vishal, final point, and this is going to put all of what we've spoken about into context. Ultimately, people have limited resources, and so they have to put things in an order of priority. And we've discussed health insurance, we've discussed an emergency fund. How do you layer that in the order of priority? Of course, a lot of people say that you need to have health insurance even before you think about investing.
Yeah, so we certainly agree with that thought that there is a need for health insurance to be there. And I think the important part about health insurance is also to define how much health insurance do you need. I think one of the things that we see happen very often is that sometimes there are tick-offs that happen just saying, do you have an emergency, do you have a healthcare fund? A health insurance policy? Answer is yes. The question is it adequate? If you're in a large city and you have an emergency which is large in terms of healthcare requirements, is a 50,000 rupees or a 1 lakh rupee cover going to be enough? So I think you need to get to getting the right amount of health insurance as well. Do not depend completely on your company health insurance cover because of the fact that you may not always be employed. And there can be times where you're between career shifts and therefore exposed if something happened to you. It's also important to keep in mind that health insurance is not just for you, but for everyone else that you may need to support financially if an event happens. So it could be spouse, children, parents, in-laws, siblings if they're dependent. So you need to look at all of that comprehensively. Once you've got the health insurance piece right, that's your way to knowing that hopefully my finances will not get into a mess because of a health emergency. Now I have to address the liquidity issue, which through a cashless process I could have addressed because I could get the cashless to take care of it. But if I don't have cashless, then I need to ensure that I can get liquidity available, or there might be certain things that my health insurance company does not cover at all. Certain illnesses for a certain period of time, or within the expenses as well, there may be certain consumables which are not covered, etc. So that's when it becomes important to start thinking about your emergency fund as well. And we need to keep in mind that emergency funds have multiple uses. They're not just for healthcare. They could be because you lost a job. They could be because there is suddenly someone who's very close to you who requires some money. And you need to step in to support it, or would ideally want to support it if you could. So that emergency fund is not just a healthcare provision. It can be used for multiple purposes. And then you get to investments. Like I said, for a lot of people, doing this one after the other can be very stressful. So for those sets of people, sometimes you may choose to do this concurrently, though it's not ideal.
Got it. I think it's been a fantastic conversation. Thanks so much for joining in, Vishal, and for speaking to me on this show. Right, so we've spoken about health insurance and we spent quite a bit talking about emergency funds as well. You've probably gotten an idea as to how to start. But when is it okay to access that emergency fund? What are the 5 reasons that you could use it for? My colleague Yukta has this report.
Life loves throwing curveballs, and your emergency fund is the bat that you swing back with. It's your financial safety net of sorts, money that's kept aside for when the unexpected shows up. Think of it as your break glass in case of emergency stash. But when can you actually use it? Now, according to experts, there are 5 main situations where it's okay to dip into your emergency fund. So rule number 1, not every surprise bill counts. But if your car suddenly breaks down and you literally need it to get to work, that's a leisure treason. Or let's say you get hit with an unexpected tax bill. Now it's painful but unavoidable. So using your emergency fund here is smarter than racking up a high interest debt. The biggest one, medical emergencies. Hospital stays, urgent procedures, these are exactly what the fund is built for. Now family emergencies also make the cut, like having to rush home last minute. Because we all know flight tickets are cheap and your emergency fund can cover that without stress. And if you're between jobs, sometimes your final paycheck or your full and final takes forever to come through. Your fund can bridge that gap so bills still get paid. So the bottom line, your emergency fund is your buffer for life's messy surprises. Build it, protect it, and if you dip in, top it back up.
Thanks, Yukta. It's now on to our special segment on Your Money Matters called Sounds Right, but Is It? You get a lot of money advice from your neighbor, from your friend, from your parents, but the question is it right? And today I'd like to talk about personal loans and whether they can affect your credit score. The simple act of taking a personal loan is unlikely to affect your credit score. That's the long and short of it. But the important thing to focus on is the context. Is the EMI that you will pay on a monthly basis going to add to an already high amount of debt that you have? If that is the case, then that's going to prove to be a red flag for the credit bureau that assigns you a credit score. Is it being used to repay a credit card loan that is overdue? If that is the case, then your credit score has already gotten affected, and it's possible that if you use this personal loan to repay that debt, it could get better, your credit score, over the period of the repayment of your personal loan if you manage to hit all of the installments on time. So bear in mind that good credit habits will work towards improving your credit score over the long term, but just taking a personal loan is not going to affect it. That brings us to the end of this edition of Your Money Matters. It's been an absolute pleasure bringing it to you. Do stay tuned. This is NDTV Profit.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company. powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the
Welcome, you're watching Market Express and I'm your host Himakshi Bahuguna. Now let's get straight into the show. So Trump's tariff tirade has triggered the selling pressure on the Lal Street. Benchmark indices closed near their intraday lows. Nifty has slipped just below its key support levels to wrap the trading around 24,500 points, while the 30-pack Sensex saw cuts of close to 700 points to end around 80,000 levels. Now, the broader markets underperformed the frontline indices, where the small and mid-cap indices fell over 1% lower. Bank and IT heavyweights contributed most to the Nifty's intraday fall. ICICI Bank, HDFC Bank, Infosys and TCS were among the top draggers. Marginal relief was observed from counters such as Reliance, L&T and Titan. All sectors end in the red, with IT, defense and realty leading the sectoral slump. Market breadth also ends highly skewed in favor of the bears. India's GDP growth is estimated at 6.7% for Q1 of FY26, as per a Bloomberg median poll of economists, now moderating from 7.4% in Q4 of FY25, but above 6.5% in Q1 of FY25. Gross value added, that is the GVA, is projected at 6.4%, with the gap persisting due to rising indirect tax collections and lower subsidies. The Reserve Bank of India forecasts 6.5% GDP growth supported by disinflation, pickup in indirect taxes and a favorable base effect. Agriculture growth is expected to ease from Q4 of FY25 but remain strong, while excess rainfall may have dented industrial GVA. Manufacturing GVA is also likely benefited from lower input costs amid global uncertainties. Overall, the growth is buoyed by robust rural demand and government capital expenditure, though private corporate capex stayed lukewarm. The Adani Group posted a landmark Q1 of FY26 with consolidated EBITDA exceeding 90,000 crore rupees for the first time. Now, this is driven by strong growth in incubating businesses such as airports, green energy, energy solutions and ports. Adani Green Energy grew operational capacity by 45% year-on-year to 15,816 megawatt, while Adani Energy Solutions secured new transmission projects with an order book of approximately 59,304 crore rupees. Adani Ports handled cargo volumes rising 11% year-on-year to 121 million metric tons. The group's net debt to EBITDA ratio stood at a healthy 2.6 times, with cash reserves over 53,800 crore rupees, which is supporting robust liquidity and planned capex of 1.5 to 1.6 lakh crore rupees for FY26. Newgen Software Technologies has received a 73 crore order for scanning and digitization of pending and disposed judicial and administrative records for an Indian state court on a turnkey basis, to be completed in 2 years. Now, this project aligns with India's ongoing e-courts initiative to modernize the judiciary through digital transformation, which is enhancing record accessibility and reducing dependency as well. The deal underscores Newgen's expertise in enterprise content management and process automation. Now, this is strengthening its position in the government sector. Shares of Newgen were last trading at 895.8 rupees on BSE following this announcement. GR Infra Projects has received a letter of intent from REC Power Development and Consultancy to develop a power transmission infrastructure project in Handia, Uttar Pradesh. Now, the project will be executed on a build, own, operate, transfer, that is the BOOT basis, with an operation and maintenance period of 35 years. Annual transmission charges for the project are set at 367 crore rupees. Now, this initiative includes establishing a 2 into 500 MVA 400 is to 220 kV substation with associated line-based bus reactors and transformers to facilitate the renewable energy evacuation. The project also reinforces GR Infra Projects' role in strengthening India's sustainable energy transmission network. E2E Networks, India's leading hyperscaler in AI or ML cloud infrastructure, has secured a 88 crore order from India AI, which is an independent business division under the Ministry of Electronics and Information Technology. So the order involves supplying of 1024 H200X SXM GPUs to JAN AI, which is also a startup developing India's foundational AI model. So the GPUs will be deployed on a single InfiniBand network fabric for high-performance computing with immediate allocation. Now, this deal enhances E2E's position in providing cutting-edge NVIDIA H200 cloud GPUs, supporting the scalable AI workloads. The company's market cap also stands at 4,711.87 crore rupees, and shares have closed flat at 2,358.7, which is reflecting steady investor sentiment amid the positive development. Protean eGov Technologies surges after securing a 1,160 crore order from UIDAI. Now, the 6-year contract involves setting up and operating Aadhaar Kendra across 471 districts. So, revenue is expected to spread evenly with a focus on real estate and manpower cost. Now, the company anticipates strong transaction volumes and contract scale up within 3 to 12 months. Equirus rates Protean eGov Technologies ad with a 960 rupee target, which is boosted by 1160 crore rupees of UIDAI contract. So the Aadhaar Seva Kendra segment is forecast to add 140 crore in the FY27 end and 180 crore in FY28 end to revenue. So the contributions are expected to start from Q3 of FY26, which is driven by growing Aadhaar update volumes. However, the Ask segment is likely to have structurally lower margins. Investec maintains a buy rating on RBL Bank with a target price of 300 rupees. The bank's management highlighted that return on asset is expected to trend upwards to 1% by Q4 of FY26, which is reflecting improving profitability. Loan growth for FY26 is also projected to outpace the peers by 3 to 4% points, driven by a focus on secured retail loans and also expansion in microfinance and card lending segments. Rakesh Gangwal and his family trust sold a 3.1% stake in Indigo for approximately 7,028 crore rupees through a block deal. Now, this is causing shares to tumble about 4% on August 28. The 1.21 crore shares were sold at 5,808 rupees each, which is roughly 4% below the market price. Now, the sale is also part of Gangwal's phased exit plan following a fallout with co-founder Rahul Bhatia. Now, since February 2022, Gangwal and his family have offloaded nearly 9% of their holdings, raising around 45,300 crore rupees. The residual stake stands at 4.78%, which is valued at 11,169 crore rupees. Dr. Agarwal's Eye Hospital will merge into Dr. Agarwal's Healthcare, which is AHCL, which already holds a 71.9% stake. So the merger is expected by Q2 of FY27, and the approvals are pending. And this also aims to simplify the corporate structure. AEHL shareholders will receive 23 AHCL shares for every 2 AEHL shares, a 15% premium to the 10-day volume weighted average price. Morgan Stanley also sees the deal as EPS accretive from FY27. The acquisition values AEHL at 22 times of EV or EBITDA, a 14% discount to the sector average. So AHCL plans to add 55 centers in FY26 and expects 20% revenue growth and 35% PAT increase. Electronics Mart reported a challenging Q1 of FY26 with the like-to-like sales down 18%, which is impacted by an unseasonal monsoon. So the company's revenue has declined to 1,739 crore rupees from 1,927 crore rupees year on year, with EBITDA margin contracting to 6.3% from 8.3%. So net profit has dropped significantly to 21.6 crore rupees from 77 crore rupees of year on year. So inventory levels remain elevated, particularly the air conditioner inventory, which is up by 250 crore rupees and expected to clear by December 2025. The company also sold, 4 IQ retail stores in Telangana and Andhra Pradesh, and also launched a new multi-brand store, Bajaj Electronics, in Andhra Pradesh. So management retains FY26 revenue growth guidance of 15% plus and aims for 6% EBITDA margin. A proposed 50% tariff on gems and jewelry export could hit India's $10 billion industry very hard. So the US, which holds a 40% market share and contributes 59% of Q1 of FY26 revenue, remains the largest buyer. With nearly one-third of the sector's $28.5 billion annual shipments headed to the US, the impact could be severe. Jewelry dominates product sales at 64%, while TV remains the top format at 57%. So the industry is also pushing its 16-brand portfolio, aiming for an in-house brands to make up 50% of B2C revenue by FY27, which is up from the current 36%. Ola Electric is aggressively targeting a 1,000 basis point gross margin expansion and aiming for 35 to 40% gross margins by FY26 exit. So this is driven by production-linked incentive. That is the PLI benefits. Now, Q1 of FY26 gross margin stood at 25.6% with expectations of 40,000 to 45,000 gross profit per vehicle. The company's FY26 volume guidance projects sales between 3.25 lakh and 3.75 lakh vehicles. This is also aiming for revenue of 4,200 to 4,700 crore rupees. The auto segment turned EBITDA positive in June 2025. Now, this is supported by strong gross margins and cost efficiencies. So, profitability is anticipated to improve significantly from Q2 of FY26 onwards as PLI benefits kick in. JTEKT India has approved a 250 crore fundraise through a rights issue of fully paid up equity shares. In Q1 of FY26, the company has posted a modest 2.3% revenue growth, which is reaching 566 crore rupees. Now, however, the profitability took a hit. EBITDA has fallen 16% to 31 crore rupees, with margins narrowing to 5% from 7%. So net profit has dropped 26.6% to 11 crore rupees. The steering and column segment continues to dominate, contributing 96% of the total revenue. So JTEKT serves major auto players including Maruti Suzuki, Toyota, Tata Motors, Mahindra and Mahindra, Honda, Isuzu, and Renault Nissan. Jefferies highlights GST rationalization as a key demand driver for two-wheeler companies, with GST rates likely to drop from 28% to 18%. Now, this change could reduce the entry-level vehicle prices by 7 to 8%. Now, this is benefiting the manufacturers like Hero MotoCorp, which sees 80% of its sales from the sub-100cc models. Consequently, Jefferies also raised its target price for top two-wheeler players, that is Hero MotoCorp, to 5,200 rupees and TVS Motor to 4,200 rupees, 4,250 rupees. Now, Bajaj Auto has been risen to 9,000 rupees and Eicher Motors to 6,925 rupees. So the tax cut is also expected to boost the demand significantly and aiding the recovery after a recent lull in the auto sector. Hero MotoCorp navigates a rocky road. Bulls celebrate a GST drop to 18%, lifting the profits, and Jefferies hold ratings with 5,200 rupee target. So new Glamour 125 and scooter launches aim to regain the market share. Valuations at 19 times of FY27, PE, and which looks pretty solid. So bears have highlighted Hero's lagging growth against the rivals, with TVS is set for 27% of EPS CAGR. Honda and Bazaar dominate the 125cc, while TVS leads the scooters. So new ABS rules may push prices up by 3,000 to 4,000, squeezing the margins. Hero must accelerate to stay competitive. A 50% tariff on Indian imports has officially kicked in under the Trump administration, marking a sharp rise from the earlier effective rate of 2.4%. JP Morgan estimates that after adjusting for exemptions and sector-specific rates, the effective tariff on India's export basket will settle around 34%. Electronics, pharma, fuels and critical minerals, making up 25% of the exports, remaining exempt. So they remain exempt. However, auto and auto parts face 25% of duties, while steel and aluminium attract the full 50%. So the move could actually, significantly impact India's trade with the US, its largest export market across multiple sectors. Time for an NDTV Profit Research special. Since 2021, 21 new age tech companies have hit the markets, while 5 stocks like Eternal, Ixigo and Nazara Tech have delivered over 100% returns. 6 including Paytm, Ola Electric and MobiKwik still trade below their issue price. Analysts remain bullish on names like MapMyIndia and FirstCry, citing strong return potential. Underperformers are focusing on margin improvement, user growth and operational efficiency. With mixed performance across the board, investors are weighing whether it's the time to bet on the beaten down tech players with long-term upside. Nvidia reported better than expected earnings and revenue, and said sales growth this quarter will remain above 50%, signaling to Wall Street that demand for artificial intelligence infrastructure shows no sign of fading. The stock, which is up 35% this year after almost tripling in 2024, slipped in extended trading as data center revenue came up short of estimates for the second straight period. Bank of America India research projects muted returns, with investors urged to adopt nimble sector rotation strategies. Long-term returns are expected to moderate at 2.4% till December 2025, favoring large-cap stocks over small and mid-cap. So, despite the foreign institutional investor outflows of $13 billion year to date, the risk-reward remains unfavorable and no revival in the FII flows is anticipated. Trade tariffs, particularly a probable 15% US tariff on Indian goods, pose downside risk along with uncertain US macroeconomic conditions. Market volatility is also expected to be influenced by earnings cuts, tariff impacts, political developments, and cautious fund flows. Apple is pushing back against the UK's plan for stricter tech regulations. The tech giant says the rules similar to the EU's could harm users and developers. The UK's Competition and Markets Authority wants to break Apple and Google's mobile market dominance. Apple also claims the changes threaten privacy, security, and innovation. The CMA insists its rules will boost competition and help UK app developers. A final decision is due in October. Prime Minister Narendra Modi and Chinese President Xi Jinping are likely to hold a crucial meeting on the sidelines of the upcoming SCO summit. Now, this high-level engagement comes amidst ongoing efforts to strengthen bilateral ties and address regional challenges. The summit will focus on enhancing cooperation in security, trade and connectivity among member states. Stay tuned for more updates on this significant diplomatic encounter. Torrential rains have created havoc in Jammu, claiming 41 lives, with 34 pilgrims killed in a massive landslide on the Vaishno Devi Yatra route. The pilgrimage has been suspended as rescue operations continue amidst record-breaking 380 mm rainfall in 24 hours. The Indian Space Research Organisation has begun construction of a new launch pad at its second spaceport in Tamil Nadu. Now, this facility, spanning 2,300 acres, will support small satellite launch vehicles, enabling up to 25 launches annually by December 2026. Now, the strategic location allows direct southward launches, saving fuel and boosting efficiency for polar orbits. Prime Minister Narendra Modi laid the foundation stone in February 2024, marking a significant step in India's space ambitions. Israeli drone strikes targeted a military building in Kiswa near Damascus, killing 6 Syrian soldiers, according to Syrian state media. The attack, which occurred Tuesday, followed another Israeli strike in Kunitra that killed 1 civilian. Syria condemned the strike as violations of its sovereignty. Meanwhile, Israel launched a raid with helicopter-borne troops near Mount Hermon, escalating tensions amid US-mediated talks. Syria's foreign ministry warned of threats to regional stability. The IDF has not commented on the operations. A tragic shooting at Annunciation Catholic schools in Minneapolis has left 2 children dead and 17 injured. The suspect, 23-year-old Robin Westmont, who died by suicide, legally purchased the rifle, shotgun and pistol used in the attack, police say. Now, Westmont fired dozens of rounds through the church's stained glass windows during a school mass. So the FBI is investigating this as a hate crime targeting Catholics, with a manifesto revealing, Westmont's disturbing motives. Navarro strikes again after laundromat for Kremlin comment. Now, White House advisor Peter Navarro labeled the Ukraine conflict Modi's war, claiming that India's purchase of discounted Russian oil has fueled Moscow's aggression and burdened the American taxpayers, while saying that India could get a 25% reduction in the US tariff if it stops buying the Russian oil. He clarified why he has called it Modi's war, because the road to peace runs in part through New Delhi. All 32 NATO members are set to meet the alliance's long-standing 2% GDP defense spending target this year, a milestone driven by Russia's 2022 invasion of Ukraine and calls from the US President Donald Trump for greater European contributions. However, only Poland, Lithuania and Latvia currently meet the new 3.5% core defense spending goal set in June, with Poland leading at 4.48%. NATO's new 5% target by 2035 includes broader security investments like cybersecurity. Secretary General Mark Rutte stressed that spending must translate into real military capabilities to ensure deterrence. Russian President Vladimir Putin and North Korean leader Kim Jong-un will join Chinese President Xi Jinping at Beijing's Victory Day parade on September 3, a bold display of unity against Western pressure. The event, marking the 80th anniversary of Japan's World War II surrender, will showcase China's military might with advanced weaponry and thousands of troops at Tiananmen Square. So, with only Slovakia's PM Robert Fico as the sole EU leader among 26 heads of state, the parade signals solidarity with sanctions hit Russia and North Korea. India Grandmaster R. Pragnananda has qualified for the Grand Chess Tour finale after a stellar runner-up finish at the Sinkfield Cup in St. Louis. American Wesley so clinched the title in a dramatic 3-way playoff, defeating Pragnananda and drawing with Fabiano Caruana. The 19-year-old Indian prodigy secured his spot with a draw against Levon Aronian and tie-break win over Caruana, joining Caruana and Aronian in the GCT finale in Sao Paulo. Well, with that, viewers, it's a wrap on this edition of Market Express, but please don't go anywhere as there's more action lined up ahead for you all on the other side of the break.
Well, the US has imposed 50% tariff on India, and with this tariff kicking in, the textile sector is expected to be one of the most impacted because of this. Now, to discuss the same, we are today joined by Pallab Banerjee, the MD of Pearl Global. So, sir, in FY25, if you look at the exports to US from India of textiles stood at close to $25 billion US, and with this 50% tariff kicking in, what has been the early impact of the same on the industry? Have exports from India halted to the US?
So, it has not halted as of yet. But what's happening is the current production, which was already happening, because if you talk of garments, especially the apparels, it's a fashion product. So it's done season-wise. And this is the time when India normally, or across the world, US actually places the spring and summer products at this point of time, which are supposed to be delivered in the month of November, December onwards. And it reaches the store. That means it's on sale in the month of February, March onwards. So this tariff, the timing of the tariff has come in such a point of time that this new order booking is definitely under pressure. The retailers and the brands of US who buys from US, almost $6 billion of apparel is going out of India. So they cannot absorb this extra 25% of tariff. In fact, if you look at it from the competing countries like Bangladesh, Indonesia, Vietnam, and all the other countries who manufacture apparels, India is at 50. So that makes a gap of almost 30%. And the penalty that we're talking about out here on top of our existing 25 is another 25. So both ways, if you look at it, India is not competitive by approximately 25 to 30% additional tariff. Now, if this is the impact which the retailers and the brands cannot absorb, so they are putting two conditions on the apparel manufacturers of India. Either to absorb this tariff, that means like we reduce our selling price by almost about 16% to avoid this 25% tariff. If you do the maths, like whatever we are shipping out at a lower price by 16%, after tariff would be same if this 25% tariff was not there. So they want that kind of price reduction, or they are pushing us, like for example, Pearl Global, the company that I'm representing, is we have manufacturing across the globe. We have in Bangladesh, Vietnam, Indonesia, and Guatemala, as well as India. So for a company like us, they're pushing us to shift the US manufacturing to other countries. Or if we're doing it out of India, then we somehow absorb this tariff burden. So that's where we are sitting. And yes, the people like who are not able to do either of these, they are going to lose the business. So this is what the situation is at this point of time.
Right, sir. So are you suggesting for the sector as such, as a whole, that 25% of the tariff is something that US clients are ready to bear, but the additional 25 they are asking the Indian exporters to bear at this moment?
Yes, that's correct. Well, first 25%, because if you see, all other countries are in the range of 19 and 20%. So the difference is less, 5%, although like India will have a uncompetitive by about this 5%, which even it can work out if India specific product, which is easily available in India, but is difficult to make in other countries. So that 5% can be shared between the two businesses, the clients and the manufacturer or the supplier from India. But when you talk of a 20 or 30% difference, then it is not possible. So this is what the situation, how it is being played.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Hello and welcome to KYC, that is Know Your Company on NDTV Profit. My name is Hiral Datia and with me is Puneet Javeri. Today on KYC, we are going to actually dissect a Quest Corp in trade. It's going to be an interesting company to talk about, and the scenario is absolutely interesting as well. The reason being is what's happening with hirings right now, because all of us have been talking about the negative impact in terms of where IT as a sector goes, because that's where majority of the downtake that has happened so far. But let's quickly run you through as to why a Quest Corp. Firstly, we want to understand the business outlook for FY26, and the reason why this is important is after the three-way demerger that has happened, how is business actually shaping up? Moving on, if you talk about the other aspects, which segments will lead the hiring in the second and the third quarter, which usually is an absolutely strong quarter? That's the second question that we ask. On number 3, what's the outlook looking like for GCC hiring, as IT as a sector has been slowing down as well? And moving on, can the professional staffing sustain the double-digit margins that we've seen so far? So these are a few of the questions that are on my list. Puneet, what are you going to look at as well?
I think one of the key aspects is, of course, of the company is largely into hiring for both banking as well as for technology, and that space has been largely impacted from the tech space. So I think that will be one. Monsoons, amongst other reasons, has been one of the key aspects which is impacting a lot of companies, but those are some of the key aspects to look at.
Right. In fact, will Middle East and Singapore growth also continue from here on is what we need to watch. What's the plan for on-site as well as GCC business transfer is what we should be looking at. And very lastly, how is the Hamara Jobs ONDC integration progressing for the company? So we usually look at 5 questions. These are 8 questions that we will try looking at with the management from here on. But moving on, let me quickly take you through, about Quest Corp. Firstly, as we know, the company is in the business of overall staffing is what we know. Apart from that, if you look at the presence, 9 countries is what they're present in, and they have a workforce of little over 550,000 associates, serving over 3,000 clients across diverse sectors. Talking about the demerger as well, they have done a 3-way demerger. All the 3 companies have been separately listed now. The main business, which is Quest Corp, is into workforce management. And the first new company is Digitide, which is into BPM solutions, InsurTech, as well as the HRO business. If you talk about the second one, which is Blue Spring,
That company is into facility management, industrial services, as well as investments. Overall, if you talk about the market split as well, Quest Corp, it actually had a market cap of around 3,900 odd crores, Digitide around 2,900 odd crores, and Blue Spring around 1,200 odd crores. And this is basis the split that had happened then. So let's just be very mindful of that aspect. If you talk about the first quarter as well, in terms of the matrix, Quest Corp around revenue of around 3,650 odd crores on a PAT of 50 crores. Blue Spring reported a loss and a revenue of around 800 odd crores, and Digitide a profit of around 10 odd crores on a revenue of around 740 odd crores. General staffing, professional staffing, overseas business and digital platforms. These are the segmentals that you're looking at, where general and professional has seen an uptick, whereas overseas business and the digital platform has seen a degrowth from 5 to 18%. So that's with regards to everything that you need to know about the company. But let's quickly take you through the rating parameters from here on. On the first one, we have the income statement that we are talking about as well. We'll talk about the balance sheet, cash flow, return ratios. Moving on, if you have to look at the other four parameters, the shareholding, street credentials, street coverage and valuations. This is what we will discuss from here on. Puneet, let's start with the income statement.
Well, definitely, it is one of the key aspects because we've seen the demerger happening now of this particular entity. So you are seeing some kind of revenue correction that we've seen. Now for FY25, and we've only taken the last 2 years because these are comparable post the demerger. If you see from the FY23 level, compare the FY25 revenue, you will see a dip, and that's largely because the two demergers of the two new companies that Hero just spoke about. So in that aspects, 14,990 crores is what they did in FY25. It is a growth, but you will see that there's an impact on the net profit substantially. It's down almost 6 times from the FY24 level. This was largely because of a demerger expense of about 30 to 40 odd crores that they did, as well as a write-off of about 118 odd crores, which impacted the profitability in FY25. So that has dragged down essentially the ratio in this particular aspect, and for that reason, we've given this a thumbs down. And in FY26, they are expecting some of these expenses won't be a part, especially the demerger expenses. The receivable aspect will be something that we'll quiz the management on. But on this aspect, we've given this a thumbs down.
Right, so that's with the income statement. Let's quickly look at the second parameter, which is the balance sheet of the company. Now, what's interesting in terms of the balance sheet is their net worth to an extent has come down significantly from a 2,800 crores that we saw in FY24. It's actually come down to little over 1,000 odd crores. And in terms of the cash and bank as well, that is nearly halved for the company. So these are two aspects that we are looking at, because of which we are giving it an absolute neutral rating so far.
Specifically, this has also seen that kind of demerger impact, which we've seen move.
There will be some movement that will happen, correct, to the other companies, which is Blue Spring and Digitide.
Yeah. And in terms of cash flow, let's move on to the third metric now, and that largely seems to be stable-ish to say the least, because we've seen that kind of degrowth in terms of hiring trends. You're seeing that impact in FY25 as well. Companies guiding for a better performance in FY26 that will be led by professional staffing as well as the hiring in GCC trends. So we've given this a neutral, not given this an absolute thumbs down, largely basis of this aspect of a better outlook. But for FY25, it was still a better performance compared to FY23, but a neutral rating, giving the uncertainty in hiring for the tech as well as among the other sectors that it caters to.
Okay, so that's with regards to where cash flows go, but let's look at the return ratios. Now, what's interesting with the return ratios is if you have to look at 23, 24 and 25, it's the lowest. So clearly, the return ratios are well below your historic highs that you've seen as well. In fact, 10.36 is where the return on capital employed was in 2024, 23, 8.45, and right now 2.92 is really low. Simultaneously, if you talk about the return on equity as well, there again that number is in single digits, 2.36 lower level, versus a 10.35 and a 8.97 that we've seen in the previous years. So clearly there is improvement that is needed on the return ratios, and that's the reason why we give it a thumbs down so far.
And essentially, the return ratios are expected to go and do better going forward. largely led by, what is happening in GCC trends amongst others, because that is a very, very high margin business for the company. But clearly the trends, seeing that impact of the high margin businesses moving to the other key verticals, and hence thumbs down. The next one is shareholding, and this largely, we've given this, in terms of shareholding, largely, in this particular aspect, a thumbs up, and that's because of maintenance of that kind of shareholding that this one has kept. So from 56%, it's largely been there. We've seen some increase from March of 2024 in terms of the level for public shareholders, and hence, we've seen in terms of the stock largely underperforming, the retail investors coming in anticipation of a better growth area. But we've given this a thumbs up based on the confidence that the promoter has kept in the business.
Okay, so that's with regards to where the overall return ratio shareholding goes. Street credentials is that we've already spoken about as well. Valuations, let's quickly look at that aspect from here on. If we can just get the overall street creds on the screen. In the last 6 months, we've seen a downtick of around 55 to 56% in terms of where the stock price goes. That the counter has actually underperformed in all parameters. If you have to look at the last 5 years as well, it's a downtick of around 31-32%. So not really rewarded the shareholders to that extent. So that is what we need to look at from here on. But, as Puneet was mentioning, the GCC hiring, which is a high margin business from here on, if that is able to improve the business, in turn, improve the return ratios as well, potential for things to come up and reverse. And that's a question that we will check with the management. But overall, a thumbs down in terms of the street credentials, Puneet.
Well, and that's largely also seeing that kind of merger impact, which we saw in April. About pre-merger, the price was 604. Post-merger, we saw that dip to 400. But since then as well, we've seen some form of impact on Quess Corp, largely basis on the operating performance as well. In terms of valuations, the nearest competitor is TeamLease, and we've always seen that kind of valuation differential between both these firms. Currently, valuation for both seems to be, on the lower side for FY27 specifically, baking in the negatives for this year. The outlook, of course, will be something to watch out for as we go into Q2 and Q3. Q2 and Q3 are, big seasons for hiring, and that does benefit companies like Quess Corp as well as TeamLease. But at least for on both the next couple of years, we've seen valuations largely been positive compared to TeamLease. But in terms of growth, that largely has been absent, and hence we're giving this a neutral for now. But in terms of commentary, that depends on what happens in Q2 and Q3, has some upside risk to say the least, and that's reflected essentially in the analyst ratings as well.
Valuations absolutely reflective in analyst ratings. But let's quickly just go through everything in terms of the street credentials that we're looking at in terms of coverage. 8 buy calls, 1 hold. But with that as well, you have a 42% upside, right? So from what Puneet is mentioning about from a valuation perspective, the business perspective, the GCC that could start contributing, probably that is what is being indicated in the upside that, the analysts are giving right now. And 8 is not a bad number, and hence a thumbs up in terms of where the street credentials go, the coverage goes. Let's quickly look at the final performance now. So the income statement is a thumbs down and your return ratios are a thumbs down. If improvement comes in, probably that could change in the future. Balance sheet cash flow, absolutely neutral because of the impact of the demerger that we've seen. Your shareholding, street coverage, both are a thumbs up. Valuation right now is sideways, but your credentials, because of the returns that it has given to investors, is a thumbs down right now. So from 8, the overall rating is a 3.5 in terms of where Quess Corp goes right now. The conversation that we will have with the management is actually going to tell us how this 3.5 probably will improve from here on or not. Let me welcome in Guru Prasad Srinivasan, Executive Director and CEO at Quess Corp. Srinivasan, welcome to the show and a pleasure to speak to you at NDTV Profit as always. My first question coming to you is, overall, with the demerger that has been done, now the business that Quess Corp will actually focus on, what's the outlook looking for FY26? Because usually Q2, Q3 is a strong quarter for the company. So taking aspects into consideration with what's happening around IT, the GCC business that you're looking at as well, which is a high margin business, how is Quess Corp actually stacking up?
Sure. Thank you so much, and happy to join you all on this call. So, first and foremost, let me start from the demerger structure in itself. So, we had a very successful demerger, which officially we announced, and two other companies that got listed in the month of June. So, Q4 results itself, if you look at, we started, announcing the result independently by each of these entities. So, Q1 is the first, standalone result that we announced of independent entity Quest Corp. A couple of specific callouts. First and foremost, we had a double-digit EBITDA growth year on year, and our debt levels have become, for Quest Corp, debt level is, we are a debt-free company now. And the other parameters are like post-demerger, the business structure in itself has become far simpler. So we have 4 line of businesses. The first one is general staffing, which contributes about 53% of our EBITDA comes from general staffing business. The second set of business is India professional staffing, where 29% of our EBITDA comes from India professional staffing business. The third quadrant is our international business. About 18% comes from our international, 18% EBITDA comes from our international business. And the last one is a digital platform which we have incubated for future in terms of building our digital strategies around. So 4 line of businesses, simplification of corporate structure, and debt-free and much leaner balance sheet is what we were able to achieve by Q1, and we've just announced that as a result.
Mr. Srinivasan, good morning, sir, and thanks so much for joining in. It's Puneet this side. You mentioned that debt has now, wiped off from the balance sheet. Essentially, that will help the return ratios for you going forward. In terms of, hiring trends, if you can give us some perspective. Quarter 2, quarter 3 generally is very strong for you. We're almost, halfway through quarter 2, and while you can't talk about numbers, have you seen any kind of hiring revival essentially in sectors like technology amongst others? If you can give us some perspective.
So let me go by platform and business. So Q2 has been definitely, we see a lot of green shoots coming across Q2. If I were to start specifically from a segment, if you look at, I think, general staffing, we have an open mandate of almost about 40,000 plus. To be precise, about 42,000 open mandate that we are on. It's a good way to start Q2. And between July and August, we have done substantial hiring, specifically in manufacturing, consumer retail, and telecom. As you rightly said, India being the season between July to up until Diwali till October, we are seeing mandates, open mandates being fulfilled, and the other sector is supply chain logistics. Specifically, I think 1 or 2 sectors which are a little slow than anticipated is BFSI is slightly slow, but otherwise manufacturing, consumer retail, telecom, and supply chain logistics is doing well. Coming to professional staffing, GCC has been the most spoken about, and we are definitely, while the mandate quantum may not be high, our fulfillment ratios are far better, and we have been able to do good. Almost 70% of our fulfillment comes from specifically from GCC as a segment. So a couple of indicators probably that viewers would be interested. The rural consumption is far higher than urban consumption. 75% rural consumption is coming up from, and that leads to a lot of expense and the investments that can go into the segment, which is helping us to probably do our more open mandates are coming in from tier 2 and tier 3 segments, which is good to see than the key markets and urban markets. So almost 37% of our hiring we have done in tier 2 and tier 3 cities as we speak, and most of the manufacturing units are also being set up in tier 2 and tier 3 locations. So that's where we are now seeing a lot of demand coming in, which is in a way good for country like us. There'll be more spending pattern in rural markets, so that is going to give rise to more jobs as we move forward.
Okay, so when you talk about an uptick that's coming in from tier 2 and tier 3 as well, which segments are you looking at in terms of hiring? What percentage of your revenues will come in from there, and in turn the margin impact that you see, is it a low margin game or is it a high margin game?
See, staffing would always would be in a range between 1.4 to 1.5% in terms of EBITDA, because it's a volume game. And I mean, the way we reorient ourselves is we definitely headcount is important for us, but profitability is much more important than our revenue. So we focus on our profitability for this business, specifically for general staffing, and of course, professional staffing has always been on EBITDA measurement. So coming back to your question, I mean, one third, I mean, almost, I said 37% of our hiring is coming in from tier 2, tier 3 segments. Again, the segments which are driving this are manufacturing, consumer retail and telecom, and logistic and supply chain. More e-commerce going closer to the customer in tier 2, tier 3 location, and you need entire delivery and solutioning around it to cater to their customer needs. So plus the retail being the season, and more retail going closer in tier 2, tier 3 location rollout. That is what, I mean, these are three segments which are driving, and it also reflects in a similar ratio in our revenue as well as we move forward.
Mr. Srinivasan, my question then is, you're talking about that margin range of 1.3 to 1.5% when it comes to staffing. But now that you're focusing on GCC, you're expanding into, global technology services, which is a high margin business. Do you see that further upside that could come in? And if yes, what should that range look like then?
Good question. So if you look at our results between Q4 and Q1, our contribution from general staffing in Q4 was about 59%. The EBITDA contribution, what I mean. And in Q1, that 59% has come down to about 53%. So while headcount grew and we had net additions, our contribution to overall EBITDA as across Quest for general staffing came down from 59 to 53. So on the same way, if you take the second quadrant, which is our professional staffing, from 21% we moved to 29%, which means our high margin businesses are contributing well back, which is helping us to, our overall blended margin across group, we moved from 1.8 to about 1.9. And by end of this year, we've been guiding and we are modeling accordingly to be around 2%, and we are on course to that.
Mr. Srinivasan, sir, a couple of questions. Now, on professional services, you mentioned professional staffing, you mentioned that, the contribution of EBITDA has gone down to 53%, but that continues to be, where the growth essentially seems to be visible. Could you talk to us about what is your strategy for increasing your GCC contribution? Because I think you mentioned that you're roughly around target. You already have 157 GCC companies that you work with, but the scope in India with the increasing focus seems to be much higher. So could you just talk to us about the opportunity, and if you can give us some kind of quantification that we could see in the next year or next couple of years for you specifically from within this segment?
I think just one correction. You said 53%. What I referred to was general staffing contribution coming down from 59 to 15. So that is what I mentioned. And by our high margin businesses going up from 21 to 29%. So that's what I was trying to clarify. And coming back to GCCs continues to be, we have, there are about, if you look at, there are about 1,600 GCCs expected to grow at 13% year on year. By 2030, it is expected to be about 2,500 GCCs who are going to set up their captives back in the country, of which currently from 1,600 we cater to about 10% of GCCs in terms of hiring. Almost about 3,000 plus around 3,300 headcount of ours are currently present in GCC. So with this, we continue to grow. Probably, I think over 20%. I wouldn't hesitate to say that the kind of demand that is coming in and the fulfillment which is coming in. And as a company, we also pivoted to cater to in terms of building better recruiter capability, bringing in more AI and digital as part of our mix to ensure that fulfillment and delivery happens much quicker and faster. So definitely this particular segment, which is high margin, would continue to grow about 20% year on year for us, and we are slated towards that.
Okay. And when you talk about IT as a segment as well, that's seeing some bit of softness right now. And plus you've seen a decline in terms of the open job mandates as well, right? So how are you actually strategizing to navigate this aspect? Because that is something which has been reflected in the fourth quarter numbers as well.
So this is specific has been the trend for IT services companies. For all IT services companies, absolutely, I would we are not seeing any major demand coming in for Q3 as well this year, as we're already close to Q3. This has been the phenomenon for almost last 6 to 8 quarters, and we've only seen headcount coming down there. However, our exposure to IT services is about 15 to 16%. We do hire in a very small format even now, but the exposure or the kind of the percentage what we cater to is about 15 to 16% currently. But otherwise, majority of our demand still comes from out of IT services. See, the other two quadrants beyond IT services are GCC, and another segment within this is all the non-tech companies hiring tech talent for domestic consumption. So there we are seeing a lot of traction. Like, companies are into their own automation journey, and there we are seeing demand coming in for non-tech companies hiring a lot of tech talent. Like, look at Quest itself. We'll have about 200 tech talent for our own technology and strategy. People are working for us, which probably 3 years ago wouldn't have been the kind of people. The kind of population that we will have only for technology. So the local adoption is also going up. So from that standpoint, the demand we still continue, or we will continue to see, coming in from specifically from non-tech companies hiring tech talent, and GCCs will continue to contribute more this year.
Right. So, Mr. Srinivasan, everything said and done, understanding what the business is doing, where it is going, what the investors now want to know is when do they start seeing good returns, right? I'm sure you cannot really respond in terms of the way stock is moving, but let's understand from a return ratio perspective as well. We've seen levels of 10.3, 10.4 on both ROE and ROCE. How long will it take you to get there, number one? And two, what's the immediate target that the company has in terms of improvement from levels of 2.9 right now?
So when would the indicators look better? Definitely this year itself. I wouldn't hesitate to say that for multiple reasons. One is we are a debt-free company, and in terms of our equity level post demerger is almost about. If I look at the kind of trajectory that we are in, between 4 quarters, we would roughly, we'll roughly deliver about 350 crores of EBITDA, and our conversion from EBITDA to PAT is higher because there is no much of depreciation line item. So from that standpoint, we are very well slated to be close to a 20% ROE company, which we have been aspirational for some time. But this year, I definitely foresee that indicator is going to be definitely ticked for as a group for us. And of course, the market
higher single digits.
Oh yeah, absolutely. We'll be close to higher teens.
Okay, you're saying in the ROE, ROCE, you'll be in higher teens.
Absolutely.
All right. This is something which I think the street was watching out for. But thank you. Completely running out of time, Mr. Srinivasan, for joining us on the show. So that was the management of Quest Corp talking to us in terms of what's expected. And I think, Puneet, the last answer is something which actually would make the investors' day. From a 2.9 to a higher teens number is really strong.
Well, definitely. And I think those key aspects which we gave a thumbs down on, those did get addressed in this conversation.
So I think that's something we should be revisiting soon, but completely out of time. With that, it's a wrap on this edition of Know Your Company. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. negative. Sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Nifty falls nearly 1%, closing above the 24,500 mark after a 200-point drop from the day's high. Mid-cap and small-cap indices also fell over 1%. Banking and financial sectors continued their multi-day losing streaks, while all major sectors ended the day in the red. 50% tariffs to hit gems, jewelry, chemicals and home decor in near term. Exporters flag liquidity crunch, urging the restoration of schemes, while the government fast-tracks the export promotion mission and pushes supply chain resilience, expecting recovery in 5 to 6 months. The group of ministers on GST to recommend early ending of compensation cess to states. Proposal to end cess by October the 31st. The council will decide on this proposal when it meets on September 3rd and 4th. Amid escalating US-China trade war in March, President Xi Jinping reached out to India with a personal letter to the President Draupadi Murmu, signaling Beijing's intent to revive ties and voicing concern over the possible New Delhi-Washington trade deal, say officials. SEBI approves stockbroking and wealth management platform Grow to go public, setting the stage for an IPO that could raise up to $1 billion. The offering is expected to value the Bengaluru-based fintech at 7 to 8 billion, marking a major milestone in India's startup and financial services ecosystem. The Adani Group of companies reports a strong financial result in Q1, driven by robust operational performance and growth across key sectors, including infrastructure, energy and logistics. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Over the next half an hour, we're going to take you through the latest in markets as well as national and international news. But on to some breaking news coming in this evening. In a significant boost for India's fintech space, the SEBI, or the Securities and Exchange Board of India, has given the green signal for Grow's much anticipated IPO. This approval sets the stage for one of the largest fintech listings in the country, with Grow expected to raise close to $1 billion. My colleague Agni Dev now joining me on the phone line with more details. Agni, first take us through what actually Grow is. We believe it's an online discount broking and direct mutual fund investment platform. But take us through that and more importantly, the context of this entire IPO.
Right, Sanjana. So first of all, let me tell you what Grow is. So as our viewers will be aware, Grow is currently India's largest discount broking platform. It's even ahead of Zerodha in terms of total active clients, and it's been at the forefront for the last few months. So India's biggest stock broking platform is now going to come out with an IPO of its own. Now, sources are telling us that the IPO papers which Grow had filed confidentially earlier this year have likely been approved by SEBI. What this entails is that the company is now going to file an updated DRHP, which will be a public document, which is an important point to note, because once the documents are public, the company's financials, the way it operates, everything will be publicly available information. Now, sources also tell us that the IPO is likely to be a $1 billion in size, which will value the company at around $7 to $8 billion. Now, this means that there will be a dilution of around 10 to 15%, which is the norm for IPOs of this size. And an earlier announcement by Grow had also revealed that the shares are expected to be listed on both NSE and BSE main boards with a face value of ₹2 each. Now, this is a developing story. We will be reaching out to the company for their comments, so do stay tuned.
Right, Agni, thank you so much for that update. This is what we know so far. The company may raise up to $1 billion, but the SEBI has essentially green-lighted Grow's entry and its IPO. And moving on, we're hearing from government sources this evening that the new 50% tariff imposed by the United States is set to significantly dent India's trade flows. Officials admit that there could be short-term disruption as supply chains are forced to recalibrate, but stress that resilience measures are already in the works.
Right, what we're picking up from the government is the fact that the 50% tariffs that came into force on August 27, there will be an impact that is seen, but what the government is foreseeing is the fact that this impact will be coming in over the next 5 to 6 months. There will be a certain pain that these industries will have to go through, especially labor-intensive sectors such as jewelry, gems and jewelry, chemicals, home decors, which includes carpets and furniture. What we're also seeing is that this impact will be short-lived. It will be a jolt, but once the supply chains are recalibrated over the next 5 to 6 months, we'll see this pain easing out for these exporters. But given the fact that there is pain coming out, the government is cognizant of that fact, and work is on fast-paced consultations, in fact, are on for the export promotion mission. This is a package that was announced in the budget this year, and it was announced initially as a 20 to 50 crore rupee project for a single year, but now it's being revamped and being rolled out as a 6-year package that will be with an outlay of 25,000 crore. That is something that we've already reported on. What we're also seeing is that the government is very focused on boosting e-commerce exports. The likes of Amazon and Flipkart, they will, on a pilot basis, possibly be allowed to run an inventory place model instead of a marketplace based model, and that will also boost e-commerce exports. That is also a story that NDTV Profit broke about a couple of days back. There is an anticipated liquidity crunch for which there will be certain amount of interest subvention schemes, market access initiatives, as well as restoration of old schemes such as the ROTTEP scheme, which are in the works as part of the export promotion mission. What we're also picking up from government sources is the fact that the focus remains on big ticket reforms, and these big ticket reforms like the 100-day reforms agenda, we have the GST rate rationalization coming up as well. Both of them are expected to boost domestic demand, and in a way that will also help cushion the impact of these tariffs. So that is what we're picking up from the government. Another important point on the next date of negotiations for the bilateral trade agreement, that has not been finalized yet, but channels remain open, and that is something that the government is working on. They very well remain hopeful of some sort of a resolution to this tariff standoff.
Right, Rishabh, thanks so much for that. And some news that came in today, a private letter from Chinese President Xi Jinping to Indian President Draupadi Murmu has come to light. This letter was sent back in March during a period of rising US and China trade tensions, expressing concerns over US agreements that could negatively impact China's interest. Xi's letter, also sent to Prime Minister Narendra Modi, named a specific provincial official to lead talks with India. Now, following this communication, then India began working on improving relations with China in June. This effort has led to an acceleration in the settlement of border disputes, with China describing the improvement in relations as the dragon-elephant tango. Now, remember, National Security Advisor Ajit Doval is leading the discussions for India, and China has also guaranteed India's supply of fertilizers and rare earth. The resumption of direct flights between the two countries is scheduled for next month, and India has lifted its restrictions on tourist visas for Chinese citizens. However, all eyes now are turning to the upcoming summit between the Chinese President Xi Jinping and, of course, Prime Minister Narendra Modi in China at the end of the week. The Prime Minister Modi's first visit since 2018 is more than symbolic, because this visit represents the most serious attempt in years to recalibrate ties after the deadly 2020 border clashes, the worst rupture in India-China relations in over